topics outside of that topic list, which is great. Again, that isn't mandatory, but it was something that I really encouraged at the very beginning. I do appreciate for some of you that are new to finance, that might be problematic. But for those of you that do want to vary that core topic, again, remember that you can do that. So, over the course of those conversations with candidates and varying the topics, I guess I came to a couple of key conclusions that I probably need to offer some of you a bit of additional clarification in relation to key topics, in particular some of the more popular ones. So those of you that are working on the Brexit topic, I'd encourage you to take a moment and actually consider what you should be doing in the context of the Brexit issue. So the Brexit referendum has already happened, all right? They've made their decision. England has made their decision. Northern Ireland has made its decision. Scotland has made its decision. Wales has made its decision. They all made their decisions independent of one another. Two decided to exit, two decided to stay. That event, that date, is a seminal date. Okay, that Brexit referendum date. In the context of your assignment, that's your key date, all right? And the reason I mention this is because, again, in discussions with some of these exemplar students, it was obviously made apparent to me that it mightn't be clear enough. I mightn't be emphasising that point enough, so I really want to emphasise that point now, okay? That Brexit event date, that referendum date, is really the critical one in terms of your analysis. What happened pre the Brexit referendum? What happened post the Brexit referendum? Okay? So how have markets performed pre and post? All right, that's really what you need to be thinking about. The actual Brexit exit activity will only happen next year. All right? That's formally when we're going to see England and Wales leave the European Union. Okay? There are going to be a number of key decisions made in relation to the quantum of money they need to provide the EU prior to their exit, any provisions that need to be put in place in relation to labour mobility and capital mobility, and there's probably going to be a transitionary period in relation to any new frameworks that are enacted around tariffs and quotas. All right, so the decisions are not small ones, but undeniably, the markets have already reacted. All right, the markets are efficient. All right, we are aware that this change is coming, and so that's already being factored into and priced into markets. And so you can actually comment on that using some very straightforward time series analysis methods. It might sound very, very complex. I use that expression. It does sound complicated, doesn't it? But time series analysis can be as simple as calculating some moving averages, looking at whether trending is auto-regressive, for argument's sake, looking at the overall trend in the pre-term and in the post-term. It can be as straightforward as that. All right? You don't need to get into any complex regression methodology unless you would like to, but you certainly don't need to. It's not expected at this level. All right? So that's something that I'd like you all to be mindful of. In relation to any of the topics that are discussing notions of alternative crowdfunding, initial coin offerings, or indeed the role of the IPO, I really want you all to remember that alternative crowdfunding models haven't been around for terribly long. All right, they haven't been around for terribly long, but we've been discussing the plausibility of them for a very, very long time. Okay? So this is something that's been discussed since 1947. Ever since the SEC was enacted and the Securities Exchange Act was enacted, we've talked about whether there's too much conservatism in the markets. And we've done a lot of research about this as well. And most have concluded, yes, there probably is too much conservatism around crowdfunding and alternative equity raising models. To an extent, we've kind of gone the other way now, haven't we? And it's in part because of laws enacted around equity crowdfunding, but it's also because technology has made certain things possible that in truth weren't possible all of one decade ago. The most obvious example would be the ICO What is an ICO? Sounds quite similar to an IPO, doesn't it? Do you think there's any rhyme or reason as to why that's the case? Why does it sound so similar? Do you think people that were using the mechanism, or indeed the first people that used that mechanism, wanted it to sound a certain way? What is an ICO? An initial coin offering. Okay? There have been over 2,200 somewhat legitimate ICOs in the last 2 years. Okay? How many firms listed on the ASX, on the NYSE, in Japan, or in Germany in that time? Nowhere near that many. I can tell you that much. So the reality is, sometimes when we talk about things in the context of finance, we need to look at the substance over the form of the transaction. What are people, for all intents and purposes, doing through an ICO? They're raising an outrageous amount of money. But they're doing it not for ownership, but rather for something else. Something that is akin to ownership. They don't own the model, they don't own the structure, but what do they own? The commodity. Okay? So, you choose to invest in an ICO, you're acquiring tokens. You'll note that everyone is very careful with their terminology. Even though it's called an initial coin offering, no coin offerer, no party offering new coin will refer to it as coin. What do they refer to it as? Refer to it as tokens. Why do they refer to the ICO as being a token issuance? Because there are laws that actively regulate how you raise money in terms of equity. And the use of the expression currency is a regulated term as well. So for all intents and purposes, these people are raising money, raising capital, through the use of an ICO. But they're not calling it that. It's called a token offering. But a couple of key things to be mindful of. How many of those 2,200 would you consider to be successful? Less than 10%. And that's me really taking a very, very broad view to what we would consider to be success. Okay? Yep. How they could go with it. Well, one of the earliest, most successful coins was called Dogecoin. Everyone remember that one? It was a coin created based around an internet meme involving a dog looking quizzically backwards at its owner. That was the third most successful coin offering for the first 4 years. All right? Questions need to be asked, without a doubt. Kanye West almost had a coin. Remember Kanye coin? He threatened to sue them. Kanye threatens to sue everyone. Seriously, look at him the wrong way and he'll threaten to sue you. But my point is that the world has changed, and this isn't unfortunately talked about in most modern textbooks. But the reality is, fundraising is happening everywhere. It's happening through equity crowdfunding models, through one of the 50 state-based crowdfunding exemptions in North America. They're happening in Australia, through our own crowdfunding mechanism, through non-broker intermediaries, and they're happening through a multitude of ICOs. Even if it isn't called an IPO, it doesn't mean that people aren't raising money. So a couple of very successful Australian ICOs have generated outrageous quantities of money in recent times. $145 million is our most successful ICO. If you don't consider that to be a capital raise, I don't know what a capital raising is. All right? Put it this way, one of my favourite companies, very innovative firm, was spun out of a Chinese consortium. Anyone heard of Opera? Opera Browser? The Opera Browser? Yeah, so the Opera Browser's been around for what, 16 years? And they've produced a huge number of different technologies around Opera, and the Opera team is a very limited team. Okay? It took them 16 years to get to market, and they raised $114 million. Okay? These ICO operators have used third-party technology to raise money around an idea that is largely unproven and have raised 145 million. What is fundraising? What is an IPO? If you're working with a coin-based distributed technology, do you need to go to IPO? Why can't you just issue more coin? I'm just saying, honestly. What is to stop? This is an example. Okay, they're not doing this, so start buying shares. But what is to stop Google from creating a distributed ad placement technology that validates advertising using a distributed ledger? It's a really good idea. For those of you that want an idea, it's a really good one to pitch. All right, you can have it. It's on me. But what's to stop them from doing that? And then when they do that, will they ever need to use a traditional fundraising mechanism? Sell ad tokens. Right? Pre-sale. Keep pre-selling ad tokens. Raising money, making money that way. I mean, you might think that that's an extreme example, but I sat with cohorts of professionals and talked to them about the impending change that was going to come in relation to touch-based technologies, and everyone thought that was farcical. All right? How many of you actually punch in your credit card details anymore for small transactions? Honestly. Who doesn't use PayWave or PayPass? We all do. These changes, they are coming. It's just a matter of when. All right, so that's what I really want you guys to think about. So those of you looking at equity crowdfunding, those of you that are looking at ICOs, those of you that are, for argument's sake, looking at the future of the IPO, think for argument's sake about how equity crowdfunding laws and the laws in relation to ICOs are changing the way that we engage in trade and commerce. And let it be known, how do you regulate an ICO? Who regulates it? How do you regulate it? I would love to have the answers here, because this is one of those questions that I'm not going to pretend that I have an answer to. The reality is, when it comes to an ICO, it's a distributed ledger technology. Everyone decides that the token is of value. Okay? It's a digital good that everyone deems to be of value. How does a third-party regulator actually regulate that? They can't regulate your decision to ascribe value to a digital good or service in a commodity or currency-like way. Very, very hard to regulate. But some will try. Can you do this in India? Is Bitcoin lawful in India? No, it's not. Are people using Bitcoin from India? Yes, they are. So is regulation working? Not really. It's actively discouraging the use of coin, but people are still doing it. All right, so they were the two topics that I felt needed some clarification. I feel like for the most part the others are fairly straightforward. Just on the Donald Trump question, you know, in light of his craziness in recent days, if you want to opt out of that question and do something else, I'll completely understand. But with that said, those of you that are doing that question, you will find that there is a huge number, I should say, a huge number of articles written on that topic that you'll be able to find on SSRN, and I'll show you how to do that as well. So we'll get into today's material, and then at the break, I'm going to show you guys how to access some viable research material and data. All right? And for those of you that are interested, I'll also explain how to get onto the books platform to access the additional book content. All right, so we'll do all of that shortly after the break. We'll just get through today's seminar. So today's seminar, in my view, is one of the really fun ones. Again, I know you're going to think, oh, that's rather laughable, Michael. Fun. I haven't had any of that yet in this seminar. I would contend this is quite an interesting topic, because I think it's changing a lot. I think the way in which we look at fundraising is changing. You've already heard from me about how things are likely to change, in my view. But don't just take it from me. Go online, have a look at what people within this category, not just academics, but people within this category that are working in technology are doing. And we're going to do a little bit of that today, but we're also going to conjecture a little bit, pontificate a little bit, try to engage in a process of dialogue such that we can figure out what things are going to look like in the future. And we're going to do this in part because you're going to be working within this brave new world. Okay? All right, let's make a start. All right, so over the course of today's discussion, we're going to be talking in particular about the process of buying and selling shares, indicators of financial performance, and share pricing methods. Okay, so coming into this discussion, you should be able to value a share and understand how to analyse the performance of a firm. Okay, they're your two key takeaways. We'll also spend some time talking about models like CAPM, albeit briefly. They are still valuable, even though they're conceptually simple, still valuable models in terms of starting your analysis journey. So, this is a starting point. We're going to talk a little bit about exchanges. I've talked about them ad nauseum already, so I'm not going to dwell too much on their origin story, but we do know that the first bourses and exchanges were likely to have existed in the Nordic region of the world. And so it's conjectured that the first markets were potentially in places like Sweden or possibly in Holland. And there are certainly some evidence suggesting that early markets also existed in Germany. In terms of organised markets for exchange, I would say that the mercantilist period in Europe in particular was a key driver of some of the first organised markets, and we saw them emerge out of places like Venice, right? The first truly organised formal markets. But you'll find markets everywhere now. The reality is markets exist everywhere, and they're very dynamic. For all intents and purposes, every market in the world that is of any significance has a deep and liquid secondary market. It's important that we appreciate the distinction between primary and secondary markets. Obviously, the primary market is the market for the first issuance of equity. The secondary market is the mechanism through which the existing equity is traded. There are restrictions placed on the level of participation that foreign parties can have within a number of markets. And so India and China in particular do place some restrictions on foreign participation. But increasingly, India and China are wanting foreign participation in domestic equity. Why do you think that is? Why do you think that is? Why are India and China so open to foreign equity now? Yeah, they're acknowledging that they do need foreign capital, and at the end of the day, there is a zero-sum game element to this. And we want to deny it, but the reality is there is at any given point in time fixed amount of capital available within the world, and everyone is, for all intents and purposes, competing with North America for that capital. Right? Its default direction is North America, and you can justify it moving somewhere else. People have been somewhat hesitant about India. Can anyone tell me why people have had a level of hesitation about India in the past? Albeit that is now not so much of an issue. What have been some of the challenges associated with investing in India's equity markets? As someone who is originally from there and has worked with a lot of startups in India, I can say that it's a challenging market in a lot of ways. Why do you think India might be challenging? I'm guessing that there are one or two people from there in this class. No one has run a business in India. No one has worked for a business in India. What are some of the challenges associated with operating a business in India? Sorry? Exactly right. So we all know the answer. Heavily regulated market. Okay, it's heavily regulated to a point of being poisoning and restrictive. All right? India also uses retrospective legislation. Why do people from the West find that really confronting? If we don't dwell on the simple stuff, we can move into the far more interesting stuff. Why is retrospective legislation really confronting when it comes to equity markets? That's exactly right. That's exactly right. Business is all about planning, all right? If you don't have a plan, what's the expression? Fail to plan? No? All right, let's move on. But if you don't have a plan, the reality is you're really going to struggle. And planning is essential to modern business. It's essential to doing anything. The reality is it's more challenging in India because you have to deal with state-based regulation and national regulation and the potential for retrospective regulation. In particular, in relation to taxation. That's when it gets a little bit scary. All right? But what has the Indian government said? What has the government said and every subsequent leader said with respect to this issue? They made it clear we're not going to do that anymore. Okay? We're not going to create that tension anymore. We're not going to cause consternation within our markets. We want to encourage capital flow into our market. And so those are artifacts of a bygone era and a bygone mindset. And so increasingly now, a huge amount of equity is flowing into India. India's desire for equity is driven in part by a want around intellectual property as well. India is very keen to engage investor groups from abroad that are happy to invest through joint venture enterprises and bring intellectual property to the table as well. India is very keen to share in relationships and partnerships that involve intellectual property sharing. And China is very much the same. Okay? But I would say India is actively championing that mindset. And that's a very logical mindset. That's how you can advance your economy rapidly. And so rules around investment have changed in these economies. They're actively incentivizing joint venture operations, and they're actively incentivizing greater foreign equity participation. What I loved, indeed what I continue to love, is that it's become such a significant thing that you can now observe on popular television advertisements talking about investing in India. So if you're not doing anything late at night, put on any major financial services channel, Sky News, okay, or Fox News for argument's sake. Have a look at the products that are being advertised. They're all investment vehicles that are going to be investing directly in China and India. Okay, and I love the very cliched advertising too. Lots of pictures of people on elephants talking about India being the future. You know, and I sit there thinking, okay, well, this isn't encouraging me to invest, but that's okay. It's clearly directed at a particular audience. But without a doubt, this is where the money is flowing. FDI flows to India and China have increased in percentage terms over the last 2 decades more than any other set of nations in the world. In the last 5 years, we've also seen substantial interest in Vietnam. Okay? Brazil and Colombia are also generating substantial interest as well. Russia, not so much. Why do you think that might be the case? Russia is generating interest, but it is challenging investing in Russia. I think that there are some amazing opportunities and amazing firms in Russia, but many do find the regulatory environment challenging as well. So it's kind of like how India was to an extent. I think there's a level of consternation. But Russia presents such great opportunities that without a doubt people are going to be looking to Russia as well. But yeah, remarkably, countries like Colombia and Brazil continue to dominate many discussions in terms of the future flow of capital. When we talk about the market, we often make reference to a number of different parameters. We make reference to the depth of market, we make reference to market liquidity, and efficient price discovery. So these are the key considerations when looking at markets. How quickly can we exploit information that we have, and indeed, how quickly must we exploit information that we have to generate a return? When I talk about this notion of efficient price discovery and using information to generate a return, it's very important that we offer this one caveat, this one disclaimer. Within all markets in the world, there are laws that preclude you from using inside information to trade. All right? The reality was that in a bygone era, information from within a firm was considered a very tradable and very salient asset that you could actually utilize. All right? Within modern securities legislation, you can't use internal information to trade. That's considered insider trading. And even small transactions generate substantial penalties. It's one of those things that the market really frowns upon now. So many, I'm not going to say many, a number of business leaders in Australia that have been caught engaging in insider trading have faced prison sentences. I really want to emphasize that there is a very formal line that we draw between inside information and what information we can publicly garner. So asking someone information about contract performance and profitability, these are all very reasonable questions. Trying to garner information about product specifics, contract sizes, and indeed any internal information in relation to profitability that cannot formally be publicly disclosed is essentially garnering information to engage in the trade of inside information, and that's unlawful. But it can happen in a seemingly innocuous way too. Has anyone heard of Martha Stewart? Okay, Martha Stewart is a rather famous person in North America. She's famous because she has a very warm persona, a very kind of caring persona. She's one of those sorts of Oprah-like figures in North America. Martha Stewart actually created a substantial empire, indeed close to $1 billion empire. But what brought this empire down, in fact, was a rather innocuous trade based on a recommendation or a series of recommendations in relation to some companies she had holdings in, and indeed her own company. And when she traded with that information, the Securities and Exchange Commission in the US deemed that she was engaging in insider trading activity, and she actually went to prison. And it was kind of astounding at the time. It was kind of like Oprah going to prison, if you could imagine. All right? So people take this stuff very seriously. All right. When we talk about IPOs, it's important to appreciate that we're not just talking about ordinary equity. We're not talking about one category of equity. The reality is there are a substantial number of different equity categorizations and indeed securities that are offered to the market for the first time. They're all considered IPOs. All right, so now we're getting into the slightly more technical side of our discussion. Okay, so the following set of assertions is important. Okay, so I'm just going to emphasize that. And the related mathematical concept is important as well. So, when we talk about a given security and we analyze a given security, we try to unpack the security. All right, we try to analyze the security using a particular lexicon of speech, and we try to unpack the security in terms of performance. These are some key considerations in relation to the security itself. So when looking at a security, one of the things that we often ask ourselves is the origin of the risk that comes from that security. We try to discuss and analyze and quantify the overall risk of the security, and then the risk of the security that derives from the market, and the risk of the security that derives from firm-specific risk. And you might quite rightly respond with, well, Michael, I don't really think that's possible. And you are correct to an extent. You can't do it in a perfect and exacting way because there is a degree of overlap. But you can isolate a substantial amount of the risk that derives from the market. Okay? Let's take one step back, though, and think about notions of risk in the broader sense, okay? Because we are going to be looking at those broad risk concepts as well in the coming weeks. But it is important, just briefly, that we take a step back and do it now as well. When we measure risk in the context of finance, how do we do so? If you were to describe financial risk to a layperson, for argument's sake, a wealth management client, how would you describe risk? Because the finance definition is very different to the general societal definition. Recall we talked about this week 1. Sorry? Okay, yeah, so the monetary risk of return for those playing at home. What else? Uncertainty, that's exactly right. And that's really what we need to get to. All right, that's the key consideration. In finance, risk relates to all uncertainty. Not just downside uncertainty, but upside uncertainty as well. So any deviation from our expectation is deemed to be risk. All right, and we use that very simple construct. Sum of square deviations that used to be referred to as average deviation, but in modern times is more correctly referred to as standard deviation. Measure of the sum of square deviations from our expectation. If we expect this return, but our return is over here, we expect this return, but our return is over here, the standard deviation measures how those returns deviate around our average. Okay? That's our overall risk measure. We can use empirical data, so all of our observations, calculate our average, measure our dispersion, or we can use a probabilistic framework. We can try to predict what is going to happen and assign probabilities to different likelihoods. And we'll obviously do both in this course. But for all intents and purposes, just think of the empirical example. Think about a situation where we have an average based on empirical data, and we have all of our observations. We've measured our dispersion around that expectation. Okay? Sometimes that's referred to as non-parametric standard deviation or historical standard deviation. I just like to think of it as standard deviation, just how you measure it. All right? That's how you measure it in most contexts. We don't need to add any further confusion. So, general standard deviation, measuring how our observations deviate from our average. That's our starting point. But what if we want to go a little bit further? We know our overall risk, but what about unpacking the firm-specific and non-firm-specific risk? How might we do that? All right, those of you that might have studied this third year as an undergrad, think back to third year. All right, or maybe even second year if you were a pure finance major. Yeah, no, you're right. We look at a lot of different things, but there is one metric that we often use. Sorry? I can't quite hear you, I'm sorry. Did you say beta? Okay, all right. Did anyone else say beta? No, all right, well the answer is beta. Okay. So beta is what we're looking for. We do use fundamental methods a lot, and we do use various analytical methods to analyze securities. When it comes to trying to capture the risk of the security that comes from the market, we use the beta measure. It's a rather unfortunate simplification of terms in a lot of respects, because the term beta is also used to describe all regression coefficients. But beta is, in fact, a coefficient. Okay? And that's why we use the term. There probably should be a separate term, because it does create some confusion, but that's how we refer to it in finance. So beta, in the context of finance and the capital asset pricing model, measures the linear association between the market and the security. Okay? You can measure association a number of different ways, can't you? Let's take a moment and consider the different ways that we can measure association between two things. We can measure the linear association between two things, right, in correlative terms. So what is correlation? Setting aside the math for a second, what is correlation? Sorry? Move together? More covert. It's hard to verbalize. It is. It's a challenging thing to verbalize, but it's a measure of linear association whereby we seek to determine the degree to which our line of best fit is most representative of the relationship. Or to put it more simply, how close all of the dots are to a trend line that we draw between the returns of the market and the returns of the security. So if you can conceptualize a y-axis, returns of market, an x-axis, returns of security, and a scatter plot representing the returns, if we were to draw a line of best fit, the correlation coefficient is measuring the closeness of those dots to the line. Okay? We look at squared deviations from our trend line. Okay? So that's correlation. All right, what about covariance? Covariance measures how two things, I was waiting for you, move together through time. Okay? Observationally. And finally, what does beta measure? That's our key measure in this course. It's really what we're going to be focusing on, understanding how to do beta analysis. What does beta measure? So we've looked at how things move through time. We've looked at the closeness of the observations to the defined trend. Beta is just the slope of the line. Beta is measuring the magnitude effect. All right, everyone's like, wow, that's amazing. That makes sense now. All the statistics that I've been taught for decades have never made sense, but that makes sense. Yeah, I know. It's okay, you can thank me later. All right, so that's the relationship between correlation, covariance, and beta. All right? People never teach it, they just teach you the math. Math is easy. The relationship to conceptualize is really, really hard. All right? Go ask someone what correlation is. Ask them to describe it to you. It's very hard. So correlation measures the closeness of two things in terms of their defined association. Beta measures the magnitude impact of one on the other, and covariance measures how two things move together through time. All right? That's the relationship. Why is beta such a useful measure? Well, they're all useful measures. Correlation coefficient is bounded between -1 and +1. Covariance is very, very useful, but very hard to interpret in relative terms. Beta is a nice, consistent, comparable measure. Why? Because it's measuring the impact of the market, for all intents and purposes, on a given security. And so we can compare the betas of many different securities. Beta is said to measure the systematic risk of the security. Beta is your measure of systematic risk. Okay? Some textbooks, rather unfortunately, go further on to say, if beta is your measure of systematic risk, those deviations from the trend line, they must be a measure of unsystematic risk. That's called clutching at straws, all right? There is no scientific basis in that, but it sounds really cool. It does. But you can't make that claim because it assumes that you're capturing all of your systematic risk perfectly, all right?
You say that systematic risk is based on all public information about corporation, and unsystematic risk is actually based on confidential information.
That's excellent, yes, 100%. Yeah, we tend to kind of not try to bring the beta and EMH discussion together, but that's 100% correct. That's exactly how you're supposed to interpret it. The logic behind bringing EMH to this discussion is that some public information will be reflected in securities price. In fact, all public information should be. But the reality is it doesn't always happen perfectly because markets aren't perfect. But private information won't be reflected. Those unsystematic factors won't reflect fully. But those unsystematic factors will indeed become public at some particular point in time. I mean, the examples I like to use are involving exemplars leaving. You know, I think that they're really good examples. You know, so for example, Chris Cuffey was at Colonial First State. You know, they did reasonably well under his tenure. And when he left, obviously he did something right because they gave him a $35 million payout. So, tough retirement, I'm sure it was. But it was a tough time for the company afterward, when you go through that time of transition. I think the best examples involve the companies like Microsoft and Apple. You know, I'm a huge fan of what Bill Gates has been able to achieve post his time at Microsoft, and indeed Steve Jobs is probably one of the most mercurial and compelling leaders within any corporation's context and of leadership. When they left, it was a challenging time for both firms. Both firms have obviously moved on, but undeniably it was a challenging time to actually transition from. But unsystematic risk can come from many different sources. It can come from, argument's sake, the poor systems that are in place within a corporation. It can come from poor organizational practices, for argument's sake. Not just from people, but think of it as being very firm-specific. Other examples could relate to the firm's hedging practices. So I like to sort of use hedging as an example because it's an example of how you could engage in a decision process and it can really work in your favor or it can completely destroy your business. So there was an Australian firm called Pashminko. It was quite a famous mining company. It was doing remarkably well. It wanted to ratchet up its returns. Okay, for all intents and purposes, it didn't have too many systematic risk factors, but it wanted to generate the highest conceivable return. So its treasury team decided to put in place what's called a collar strategy. Okay? So a collar strategy is a combination of a cap and a floor. Okay? And it can sometimes work in your favor because you can sell at one position and buy at the other position, generate a return from the sell position If no one exercises the buy position, you've made lots of money. You know, everyone cheers when you're in a treasury team when you do that. It didn't work out that way. They maintained a hedge position that worked against them, and as a result of that ongoing hedge position, the company actually ceased to operate because every single contract that it had in place was not profitable because of the hedge that it had in place in relation to a couple of key commodities. All right? So that's an example of how your management decisions can actually impact upon the risk of your firm. Very, very hard to quantify that. No one outside of the firm would have known that. All right? But when it did become known, they went from being worth over $24 a share to being worth around 7 cents. You know, had a fairly substantial impact. All right. So when it comes to interpreting systematic versus unsystematic risk, it's important to appreciate just what that beta construct actually means. And we're going to take some time out later in the course to sort of talk a bit more about that as well. All right? We'll just start with that generalized discussion. Beta is a measure of systematic risk. Okay, it is our magnitude measure. All right, when it comes to constructing an investment portfolio, we often make reference to the notion that we want to achieve the highest conceivable return with the lowest risk. Many would argue, and you'll find this in many old world textbooks, if you open up some of the most famous texts that have ever been written, they'll include the following statement. You should never be anticipating or indeed require greater returns for risk that you don't have to take. What does that actually mean in the context of portfolio theory? It is the basis for modern portfolio theory. Well, first of all, is it true? And secondly, if not or if so, what are they getting at? Should you require a greater return for risk that you don't have to take? Any thoughts? Well, as I said, you'll find that every textbook says, no, you shouldn't expect a return for risk that you don't have to take. And so the contention is, every security is made up of some unsystematic risk and some systematic risk. By combining securities in a portfolio, you can essentially address which component of risk? Which risk can you diminish? Unsystematic risk, that's exactly right. And so the original theory contended that 20 securities selected at random from a portfolio achieved close to full unsystematic risk diversification. All right? So the argument was that if you, I don't know, threw up 200 securities on a dartboard and you threw darts at the board, you'd be able to address the vast majority of your risk through a randomization strategy. The reality is we want to do better than that, don't we? We want to reduce our risk while also generating the highest conceivable return. And so what do we endeavour to do? We endeavour to combine in portfolios well-performed assets that don't exhibit what level of correlation? Don't exhibit. We want to combine in a portfolio assets that don't exhibit perfect positive correlation. Because if they exhibit perfect positive correlation, we're just averaging the risk. Okay? We want some offsetting movement benefit. That's the notion behind portfolio theory, that when one security is up, the other might be down. In an ideal world, you would find two securities that have high average returns and diametrically opposed risks. Perfect negative correlation. But the vast majority of securities are positively correlated. Because the markets, for all intents and purposes, move up, move forward, increase in terms of the points value through time, don't they? So you're going to find that almost all securities, or the majority of securities, are positively correlated. But that is not to say that you can't find opportunities to generate a diversification benefit and also maintain a comparable return. This is a very extreme example, But consider two securities, okay? One has a return of 10%, the other has a return of 10%, okay? One has a standard deviation of 5%, the other has a standard deviation of 5%, all right? If we invest in each security separate to the other, that is the entirety of our exposure. In a perfect scenario, they would be perfectly negatively correlated. And if we invest in both, we maintain the same expected return while doing what? Reducing our standard deviation. That's the extreme scenario. You're not going to encounter that in the real world. What you're trying to do is reduce the overall risk represented by your portfolio by combining non-perfectly positively correlated assets. All right? Asset selection is much more meticulous than textbooks make it out to be. But you should try to inform your decision-making as much as you can by the underlying mathematics of asset selection. All right? So what are the key things that we should be doing? Well, we're going to go through methods of analysis in a moment. Okay, fundamental analysis versus technical. And we'll then go into how you take the next step in terms of asset selection and how you combine assets. All right? What I would say is that obviously in the real world, you're not going to be doing these calculations by hand. So you have the ability to actually optimize your portfolio while doing it in a spreadsheeting tool or a statistical analysis tool, which makes things much more straightforward. All right. When it comes to investment approaches, there are two very high-level approaches that one can take to investment. The first is described as an active investment approach, a portfolio structure based on share analysis, new information, and risk-return preferences. And we talked to Calvin about that, what his firm does at Deloitte Financial Services. They take an active investment approach on behalf of their client groups. That's justifying your place. A passive investment approach involves the replication of market indices. And this happens quite a bit as well. But let's not suggest that this is a nothing exercise. You might think, well, why do people get paid well to merely replicate indices? Well, the idea is to not just replicate the index. The idea is to look at the index and try to improve the structure of the portfolio that you put together while replicating the index. You might choose to exclude certain securities, for argument's sake, based on their likely underperformance. But the reality is the active approach is far more complex than the passive approach. But what I love about all of this is that for all intents and purposes, you're talking about like a simple factorial representing all potential combinations within the ASX 200. So the reality is the best and worst traders in the world, in terms of performance, within the scope of possibility, only have a limited subset of opportunities in terms of direct investment. What you do beyond your direct investment is also critical. The use of option strategies in relation to your preferred securities is critical. All right? Viable option strategies are going to ratchet up your return substantially. Okay? Equally, using hedge positions appropriately to moderate your exposures is also of critical importance. Okay? But the reality is it's very much like picking winners and losers. How many of you like picking the outcome of a sporting contest? Anyone? No? Yeah? Anyone like cricket, basketball? Cricket? Yeah, so there is a huge movement that exists around sports market prediction for rather unfortunate purposes for the most part. Now, a lot of people do this because they enjoy the process of gambling, but there are also a lot of people that just enjoy the process of mathematical speculation. One of the things that we frequently do is we try to use non-traditional models, so I like to use machine learning models, to predict the outcome of sporting contests. And the idea is that we construct models and calibrate models well that account appropriately for the nuanced factors that will reflect the performance of competing sporting teams. Prediction in the context of a firm, in many respects, is very similar. All right? You try to construct a subset of factors that are going to be critical determinants of likely future performance. You engage in the process of speculation, conjecture, and if you're able to, mathematical prediction or projection in relation to those variables, and you try to discern who's going to do well and who's not going to do well. All right? It's like anything. That's why when we talk about finance as being a very discrete discipline, in truth, it's really not. It's just it's a discipline that teaches us how to engage in appropriate conjecture and prediction. Okay? That's really what it's about. Okay, so when you're with an investor and you start a dialogue with them about what they should be investing in, how they should be investing, and what factors they should be considering, these are the key considerations. As a wealth manager, first and foremost, what you will do is discern the propensities of the individual that you're working with. Even if whether it's a high net worth individual, someone planning for their retirement for argument's sake, or indeed a firm, you need to first and foremost discern one thing about the client. And what's that? What's our starting point?
Profile of the client. We take the
Yep.
profile of the client.
And what's the critical outcome of that profiling?
Like, what is he expecting? Like, what is the purpose of the investment?
Most certainly. And so we tend to categorize investors, don't we? We often categorize investors in the first instance in relation to their level of risk aversion. Okay? And so we use simple toolkits to try to analyze how someone accepts losses and gains, to discern whether they're risk averse or risk taking, where they sit along that spectrum. Okay? Once we've done that, we can start to inform them about opportunities in relation to specific securities. So let's consider how we would go about discussing a given set of securities with a client along the following dimensions. The dimensions of risk versus return, investment time horizon, income versus capital growth, and domestic versus international shares. Let's start with this notion of risk versus return. When you ask people about the association between the two, you normally get a parroted textbook response that's something along the lines of higher risk equals higher return. And that's clearly not correct, because if it were correct, none of you would be here, because you would all be out investing in high-risk endeavours. That would be the basis for everyone's investment. There would be no need for a class. The reality is, for all intents and purposes, the greater the risk that attaches to a project, the greater the return that we require from that project. Okay? The greater the risk that attaches to the project, the greater the return that we require given that risk, because we require greater compensation if risk is elevated. Think, for argument's sake, about the likely profiling and attitude toward risk of, for argument's sake, someone that's approaching retirement versus someone that is constructing their first portfolio in their early 20s. How do you think their risk profiling would likely vary? What would be some of their expectations, needs, and wants at someone nearing retirement age versus someone that is approaching investment for the first time?
When nearing the retirement age, they expect a systematic return. That like there should be like some return, like which is a guaranteed return, like every month it should be or every year they should be getting.
Okay.
Those who are investing for like short-term purpose, they expect like more return in less period of time.
So you might say, for argument's sake, the older investor that's approaching retirement wants greater earnings consistency, and as a consequence, lower risk attaching to their investment. They're happy to forego some return for some earnings consistency. And so blue chip securities are likely to be a very obvious choice for them. Securities that have consistently paid well, that are not operating at very high price to earnings multiples, unfortunately. You can't get both, can you? Great consistent earnings and high multiples.
From more like debt type of funds, debt funds, like which are
Some debt-based instruments could be a great option if they're high ranking or if the ratings that attach are good. But in the context of equity, if we use the equity lens, I would say they would probably prefer earnings consistency. All right, someone that's younger, for argument's sake, might be much more open to speculation in relation to their early stage investment. All right? All right, what about investment time horizon? Why does that matter so much?
Whether it is a long-term investment or short-term investment.
Yeah, that's exactly right. So we need to really appreciate when the individual requires cash flows and returns. All right, there is no point putting someone into a highly speculative short-term investment if, for argument's sake, they're wanting something that's longer term. But perhaps more importantly, the more extreme scenario would be putting someone into a long-term investment, okay, that results in fees and losses if they opt out early, that is wanting something potentially earlier or wanting investment flexibility. So we need to be very, very mindful of that investment time horizon. And it's also important because in almost every jurisdiction in the world, there are capital gains laws. Why do capital gains laws impact our decision process? Yep. That's exactly right. For all intents and purposes, if you carry a security for greater than 12 months, okay, it's unlikely that the income attaching to that security is going to be considered income from ordinary concepts or your ordinary income. It's likely to be considered a capital gain, and consequently you get preferential tax treatment, which is advantageous. And this affects how we structure a portfolio on behalf of a client. If they are happy to accept that investment term, then it's obviously going to be highly beneficial to them to maintain the investment for that minimum investment hold term, the minimum 12 months. All right. So income versus capital gains. Well, this is an interesting one. I mean, we've talked about this a little bit already. You know, we've talked about Amazon, and now we could probably add Apple to an extent to that grouping as well. Companies that aren't operating at very high earnings levels, but have a very substantial price multiple. All right. Are they not good investments? Well, the reality is it really depends on what you want out of it. All right. Even if a firm isn't generating substantial earnings or paying substantial dividends, if their share price is going up, that's good, because the investor can choose to exit and generate their own dividend. They can replicate a dividend structure. The problem is placing reliance on gains in capital means that it's in the market's control. Okay, you really can't control the outcome on behalf of the client because, for all intents and purposes, if the price goes up, they can realize a gain, but if it doesn't, the investor is obviously losing out in terms of holding the security. And so, again, Amazon and Apple are very good examples of that right now. Okay, they're not generating the profits to justify their price per se. Facebook is another example. But the reason I think is compelling. Obviously, people believe that there's something more there. There's greater underlying potential. Okay, so be mindful of that. For all intents and purposes, we'd always prefer capital gains over income. Why is that? Because of the tax consequences. All right, it's always going to be preferred, but we just can't control it. All right, domestic versus international shares. This is a key consideration for investors too. Many investors are very averse to investing abroad because there's a level of consternation or worry about that process of investing abroad. Should we invest abroad? How much risk are we going to have to carry? How much risk are we going to have to engage with by virtue of our unfamiliarity with that market? The reality is Australian investors are substantial investors in foreign securities by virtue of their superannuation. So most super funds do assign a portion of investment to foreign securities. So we invest indirectly quite heavily in foreign securities. When it comes to our direct investment and direct holdings, we tend to be a little bit more risk averse. Okay, we tend to invest less abroad ourselves. It's quite interesting because you'll find that that's not necessarily true of high net worth individuals, both locally and abroad. High net worth individuals in India, high net worth individuals in Australia have both been shown to be very active players in foreign equity markets. And I think for obvious reasons, they're very good at asset selection. Okay? But it is a critical consideration. Without a doubt at the moment, if you were looking for investment opportunities, you'd certainly be looking far more in India and China than you would be locally, just by virtue of the sheer volume of IPOs in those countries relative to Australia. But we are changing some laws around investment to actively incentivise more domestic investment, but again, there need to be the opportunities as well. All right. When it comes to investment, we could take a strategic approach or a tactical approach. A strategic approach is one that involves some fundamental analysis, some foresight in relation to what we envisage is going to happen. Okay? So, for example, there are a lot of strategic investors that have invested in Rio Tinto. Why do you think that is? Why do you think there are so many strategic investors that have maintained such substantial and ongoing holdings in Rio Tinto? Any thoughts? Yeah, so Rio Tinto does evidence substantial potential. Another really key reason is that there is an acquisition, how do I put it, an acquisition element already built into the price. So the Rio Tinto price is not just representative of its performance, it's also representative of the appetite that so many foreign firms have for Rio. All right, and indeed Bilton does too, but they're not going to be allowed to do that. Probably won't be allowed because it's going to be deemed in the national interest to sort of maintain the two entities. But equally, it's unlikely that a foreign firm will be allowed to acquire Rio as well. So it's an interesting one. Okay, but many people are conjecturing that at some point the Foreign Investment Review Board will say, all right, someone's going to make a bid for Rio Tinto, and we'll say yes. All right, it's a very strategic approach to be taken to investing. Tactical investment is investment that is directed at or responds to underlying activities within the market. So essentially, it's a little bit more reactionary. If this, then that. If this, then that. So we seek to invest based on key activities occurring within the market at any given point in time. Strategic investors, obviously there's no potential for payoff, but it's a low-risk position because more often than not, it involves a longer-term foresight-driven decision process. Tactical investment is more reactionary, but again, we need to be familiar with both methods, and we need to understand how to apply that logic set to all securities. When looking at the top 200 companies in Australia, I need to be thinking strategically about acquisitions and divestitures and merger potential. Equally, I need to be mindful of contract positions and contract performance levels to engage in potential tactical decision processes. Okay? Strategic versus tactical. All right, buying and selling shares. In Australia, we don't really like full-service broking because we think that we're smarter than that. We don't think we need it. All right? And that's not entirely true. Australian people are not. I mean, we're actually, I'd say, generally quite good when it comes to, acceptance of ambiguity, and we don't think too much of ourselves. But the reality is our market has never evolved in a way that's really encouraged the use of full-service broking. Very different to North America. I'm going to show you guys some AI platforms, okay, that automatically push recommendations to investors based on the US model. In the US, all right, you have a trusted advisor. That advisor calls you when he has an opportunity and he says, hey, these shares are looking pretty good. Do you want to buy some? And you say yes or no. That is legitimately how it works. In Australia, what do most people do? Yeah, we set up an account with CommSec, set up an account with another, for example, EDI provider, simple platform provider, whereby we can just trade ourselves. Okay, we know our market reasonably well, and we're happy to do so. Very, very different model in the US.
Those two models reflect, information that's available now, over the last 30 years, and there's a lot more information now. There's a lot more providers or analysis of
Yes and no. I would say you are correct. You can stay up to date with our markets more by virtue of the size differential. But for example, most traders still do actively engage in the top 400 securities in North America. And so in that context, I would say that they're still pretty well informed. And I would say their public broadcasting and financial services broadcasting services, as terrible as this is going to sound, are probably a little bit better than ours because they cover financial services issues much more in the mainstream. But Australians do stay remarkably up to date when it comes to the top top enterprises. If you look at data around disclosure and utilization of data, you are correct. We do utilize data really, really well here, relatively speaking. But I do also think it's a mindset thing as well. We're very comfortable with investment because we all participate by virtue of super. And I think that engenders a sense of confidence or trust in markets that causes people to gravitate to personal investment more. I think in the US, there's a level of ambiguity, maybe, with respect to market opportunity, or indeed a fear of engaging with markets with a lack of information, as was suggested. And so the model is very different. Here, there are still full-service brokers, but they're few and far between. One of the firms that I work with, we had a high net worth client group, okay? But they were really high net worth clients, you know, that got that service level, that wanted that service level. There weren't many outside of that category that really wanted that level of service at all. Look, and it was remarkable to me because I felt that there was still an absence of that. I do still think that there is potential in more full-service brokerage in Australia, but it's just that market capture issue. You know, how do you go to a market that's already captive to investment and say, well, hey, here's something better? And so it may well be data providers and data services that are quite popular. What I will say is we do also subscribe to a large number of data providers and data services here, and broker magazines. People use that information much more. But again, many countries around the world, and India is another example, with high net worth individuals in India, they like investment advice. They do.
Like most of the financial institutions, they're like, by default they choose like, there's a top 500 fortune company.
Mm-hmm.
By default they choose a particular set of companies in the portfolio.
Yeah.
Like the investor, he needs to choose those companies.
Yeah, and so we have similar rules in Australia in relation to super, but in relation to personal investment, for the most part, obviously people do their own thing. But I do find it interesting that just how different the models are that have been enacted in some countries. And so the UK is kind of somewhere in between us and the US. More full-service brokerage than here, but certainly far less than the US. It's interesting, I get more phone calls from full-service brokers out of the US and the UK than I do from Australia. Who gets those phone calls? Yeah, I love talking to them. Isn't it? It's fun. You should take the call and listen to them for a minute or two. It's an enjoyable process. They're always trying to push gold. You know, how many gold stocks do you own? You need to be investing in gold. It's like their response to everything. Invest in gold. Some of them are much more astute than that, but that's the messaging that I've been receiving anyway. And clearly I'm not a fan of that model of brokerage, but I can appreciate how popular it is. Why am I emphasizing this? There are still opportunities within our market to work as a full-service broker if you do enjoy that process. Okay? Okay, taxation is really, really important. Okay? Why is this an very important issue? What's everyone talking about in Australia at the moment? Who's been following this debate? Gosh, it's so good at the moment. We're actually talking about legitimate economic things. Negative gearing, dividend imputation, and a Buffett super tax. My gosh, all three all at once. It's crazy. We're going to be like California soon. Seriously. Has anyone been following that? Okay. It's great that you guys have followed my advice on reading the Fin every day that you get freely through Deakin. The Australian Financial Review is actually a really, really well-produced publication. Okay? Some of our mainstream publications are not that great. I'm not going to lie. I love them because I read sports in them. But outside of that, they're not that great. You should read the Fin. You get it for free. Read it. It's really good. We used to have another one that was okay called BRW, but they've been both kind of been spun into a single project, single initiative now. So it's probably the best one that we have. All right. So those of you that have been reading the Fin in recent times would have seen substantial coverage on a number of these issues. Okay. So we're going to go through each of them. Okay. First of all, this notion of a Buffett tax. Has anyone heard about that? The Buffett tax is named after who? Anyone know who the Buffett tax is named after? Warren Buffett. Good. Everyone knows who he is. All right. I love Warren Buffett because he donated $47 billion to charity How can you not love someone like that? He's an amazing guy. All right, everyone hated him because they thought he was so greedy, and then he literally gave away his entire fortune. And everyone on Wall Street shut up. It was really funny. He just enjoys the process of making money. But what I find interesting about Warren Buffett is he's also very justice-driven. And so 2 of the books that I'm going to circulate to you guys were produced by Warren Buffett. One of them is a book on how to write with simplicity and eloquence for financial markets. So I'm going to distribute that to you guys via email. Okay, and you can distribute it to your colleagues as well because we have the rights to do that. Colleagues within the Deacon program. And the other that he's produced speaks to investment rules and how to engage with investment and contrarian mindsets. And so I'll distribute some of that material as well. I'm not saying he's the best investor in the world. I think that there are many amazing and talented people in the markets, but he does some very interesting things, and he's also very justice-driven. So the Buffett tax law, or indeed the initial rules that were framed around tax laws and major tax changes in North America, were described as Buffett rules because he loves his team, and he spent some time with his secretary helping her with her taxes. And what did he discover? Who was paying at a high marginal tax rate? Warren Buffett or his secretary? His secretary, substantially more. Okay? His secretary was paying substantially more because he was really smart and benefiting from investment offset rules. And he's just an astute individual. He knew how to create sufficient offsets such that his marginal tax rate was less than half of the marginal tax rate of his secretary. And he was really upset about that. And I think that's a really compelling thing. You know, knowing that you're doing the right thing but still not entirely happy with the outcome because of how it affects other people. And so many states have sought to enact laws that result in you paying a minimum amount of taxation, regardless of the offsets that you create. So even if you're earning $100 million, okay, earning a substantial amount of money, but you're generating sufficient offsets such that you don't pay much tax at all, you have to pay a minimum amount, 30%, 35%, something along those lines. All right, that's the first rule that we're conjecturing. That's going to have an impact upon markets, okay? And in particular, the appetite that people have for certain categories of investment. Okay, so we'll talk about that. The next rule that's being conjectured is a change to negative gearing laws, which would result in individuals not being able to claim the same level of offset against income from ordinary concepts. Some rules have already been changed without people even really noticing. So rules in relation to what you can claim for travel have already changed. The ATO has already changed all of those rules. But again, a key discussion point. And the final consideration is this one. Dividend imputation. Our lovely Australian innovation. They're conjecturing whether it should be in place. This is one of those few financial services concepts where the name doesn't explain what it is. It's a terrible name. All right? It should be something like dividend tax offset. All right? Not dividend imputation. It's a very confusing set of terms. But what I want you guys to appreciate is dividend imputation rules are simple rules that allow you to reduce your tax liability such that you are paying only at your marginal tax rate. Dividend imputation seeks to avoid double taxation. That's all that it's doing. All right? Within many jurisdictions around the world, so for example, within India, for argument's sake, all right? How does it work when you receive a dividend from a company? Yep. What was that? Yeah. Do you get a full refund though? You get a full refund now? My understanding is that you don't get a full refund. My understanding is that you get a refund to a certain marginal tax level. Okay. I'll have to look into that again, but yeah. So there's a formal offset restriction. So in Australia, there's no restriction. Okay? You can keep doing this as much as you want. And that's why people have an issue. So dividend imputation in India, was enacted in response to our framework. All right? They don't call it dividend imputation in India, though. But they placed a cap on the extent to which you can do this. In Australia, we're now conjecturing whether we should restrict this activity. I don't know. I'm uncertain about this one because I think that obviously it does encourage investment in certain securities. It makes them attractive, but it does result in high net worth individuals reducing their tax liability rather dramatically. But it is to benefit everyone. This rule is in place to benefit everyone. You get a full refund, for argument's sake, if a company is paying tax, but you shouldn't be. That money is refunded to you because you should only be paying tax at your marginal tax rate. Prior to 1987, dividends were taxed twice. That was true of every country in the world at that point in history. We did something rather novel. Only a handful of countries were doing this at the time. We decided that we would create a system that resulted in no double taxation. If a company paid tax, you would receive a franking credit that would reduce your tax liability. Okay? Similar laws have been enacted within a number of countries around the world now. But the key point of difference is that they restricted the offset rule, which meant that this didn't serve as a mechanism through which people could dramatically reduce their tax liability. So what could someone do using this system to reduce their tax liability substantially?
Well, they could bring the dividend into an entity that at a low taxation inbox. So let's say the average tax rate in that entity was 0. If you introduce a dividend in that entity, then you get a refund. So the question here is really about whether you get a refund of that tax paid or not. It's not about double taxation from what Michael was saying.
Well, I think there is a desire to avoid double taxation, but to limit the extent to which people can benefit from the scheme. And so the system itself is very, very simple. I'm going to make clear that if you do get a question about dividend imputation, it's never going to be about a set of calculations at multiple tax rates. It's a very unfair thing to do to anyone in an exam, is to give them a tax schedule and then tell them to apply imputation laws. All right? But you might be required to explain the system using a mathematical example. Okay? Which means that you would construct an example, which has to be technically valid. All right? So how does the system actually work? Let's just go through it. Here we have taxable income of $100, a tax liability at 30%. Okay? Under the traditional model, you would receive $70 in your pocket, and then you would pay tax on that $70. I'm going to keep the numbers even simpler in the example that I present to you. Let's say, for argument's sake, you receive that $70 and the marginal tax rate is 50% rather than 48.5. Just to keep the numbers simple. That means you're going to pay $35 in tax. All right? Which means that your effective marginal tax rate is 65%. It's really high. All dividend imputation does, for all intents and purposes, is allow you to claim the tax that was paid by the company as an offset. Okay? It serves as a tax offset to you. So let's go through the examples again now, but with dividend imputation. So under the dividend imputation system, $100, tax liability of $30, you get $70 in your pocket. But this is the weird part. All right, this is the weird part. In your income statement, you put a full 100. Why must you put the full 100? Because in a moment, the tax office will say, hey, well, indeed, the tax office won't. The company will say, and you'll remit to the tax office. The company will say, well, hey, this is the imputation notice. You get a franking credit or an imputation credit to the equivalent value of the tax we've already paid. So you include 100 on your income statement. Okay? If, for argument's sake, the tax rate is 48.5 as it is in this example, you deduct 48.5%, but lo and behold, that 48.5% is now reduced by 30. Okay? Why? Because you have this lovely tax liability already paid, and you get that as a franking credit. So it reduces your tax liability. So now, you only pay $18.50. So if you only pay $18.50, what does that actually mean? Well, 70 less $18.50 is what? $51.50, which is the right value. You've now paid effectively only 48.5% in tax. You've paid 30 through the company plus 18.50 directly through you. Okay? We'd love a couple of questions on this before we proceed. Yep. Correct. They give you an imputation notice. Yeah. And so what would happen if, for argument's sake, your marginal tax rate was 0? Yeah, you'd get a full refund. Okay? So it is actually a really good system. Again, Paul Keating. Give him a call, thank him. He did some good things. I don't know if anyone calls him anymore. He's a talented guy. You might be on the phone a while, but you'll learn something. No, for all intents and purposes, this was a Hawke and Keating government program. It's a good decision, but has it been overutilised? That's the question that we're now asking. But it changes your investment incentives. Think about how you would guide it. Okay, there's a lot of interest in Australian assets from Singapore, Hong Kong, and North America, all right, and China, but predominantly through Singapore and Hong Kong, all right. How would you be guiding investor groups in relation to imputation category companies and non-imputation category companies? What should your guidance be? This is a good question. So when you're guiding investor groups, domestic investor groups versus foreign investor groups, what's the obvious thing that you need to be telling them? Do they get any benefit out of this if they're foreign investor groups? None whatsoever. You, in fact, want companies that are minimising their tax position. Okay? Maximising their earnings to maximise the dividend yield to your foreign investor. If this is a foreign investor, this is not beneficial to them. If this is a domestic investor, this is a great system. All right. What are the...
On that point, I mean, the main issue there is obviously super funds are taking 15%. I think this is getting flushed out in the media is actually anyone who's got these investments in super funds, they're getting cash refunds from their share investors.
No, you are correct. And I mean, is that even a bad thing? It's an ideological question. I would love for someone to do this as an assignment. I know it's asking a bit, but do you know what? If you want to do this, email me, please. Seriously. Do it as an assignment. It'd be great. I'll really enjoy reading your assignment. I really will. Because I haven't formulated a view on this yet. It's nice to be informed by other people's thinking around the subject. All right. Well, I think I do have an ideological view about upper caps, but I think that's probably one that many of us would probably share. But in terms of the core issue, I think it will be an interesting one. All right, setting that aside, capital gains tax. Prior to 1985, tax-free. Wasn't it a wonderful world? Carry capital assets, make money, sell them, not pay any tax. Look, a lot of it was classified as income from ordinary concepts. Let that be known. Some textbooks forget that part. In fact, most textbooks forget that part. But many things were tax exempt. All right, between 1985 and 1999, okay, we had a simple holding rule. Okay, and post-1999, this is the only rule you need to be familiar with. Okay, 50% discounted gain if held for for at least 12 months. Or indexed if purchased during those intervals. Okay, so how does it work in China and India and the US? Obviously, different states have different rules in place in relation to some capital gains assets in North America, so I don't expect you to know all the state-based rules, but there are some rules you might be familiar with. No, but in India there's also an indexation rule. Yeah. So how does the indexation rule work? Yeah, so in India and in the vast majority of emerging nations, and indeed many developed countries, they still maintain an indexation rule, which means that you look at a base year value, you look at your inflated value, you apply that rule to your asset, you only look at the amount over and above the inflation rule. No, they do look at indexation in respect of a large number of assets. No, not in relation to equity, but no, these rules are in relation to capital gains generally. Yeah. In Australia, we don't use indexation either. Yeah. We did though. We used to. So, what makes this rule interesting is that it's now a major discount. It's a major discount. You're talking about 50%. All right. So this actively incentivizes longer-term holdings when it comes to equity. All right, without a doubt, this drives your decision making. But the reality is, if you are seeing in the future, in the foreseeable future, a potential loss in your security, that's where the decision process becomes a little bit more complicated. All right, so let's take a moment to consider the decision process when you're approaching 12 months. If, for argument's sake, you're approaching 12 months and there is the potential or plausibility for the likelihood of, for argument's sake, a loss, my apologies, not a loss, a lower gain on the security, you need to actually assess both scenarios, whether the lower gain is going to be more favourable because of the 50% discount, or the higher gain applied at your marginal tax rate is going to be beneficial. That's what you need to be doing on behalf of your clients. Okay? When you're realising assets on their behalf, if you're providing a high net worth service, this is the kind of decision process you need to be considering. All right. It's interesting, but the rules in relation to share trading very, very different to the rules in relation to gambling. Okay, it's very, very hard to lay claim to losses as being legitimate losses through a process of gambling because it's obviously a game of chance as opposed to a game of skill. But remarkably, when it comes to losses in other categories, obviously we look at them slightly differently. When it comes to gains, however, if for argument's sake you're making substantial ongoing gains from a gambling activity, that is considered income from ordinary concepts. If you're deemed to be engaging in a process that has both a structure and a business-like approach incorporated into it. Anyway, I just thought that was an interesting aside. I do think that there is a difference, though. There is far more skill and logic to share-based investment than there is to gambling, but often students draw that analogue, and I want you to appreciate that the law actually doesn't draw the same analogue. All right, financial performance indicators. So I like this part of our discussion because I think that we should all have good fundamentals. Okay? One of the first things, the first partner that I ever worked for said to me was that the most important thing you can ever have when you start out a job is good fundamentals. You don't need to know everything. You just need to have a good grounding in things. Okay? In fact, many people think that much of what is taught in a university context, particularly the esoteric stuff, can be a little bit over the top. Having good fundamentals will always hold you in good stead. All right? So what do I mean? Well, having good fundamentals is often associated with understanding how a firm functions and being able to articulate that using business model analysis, okay, and using metrics, okay? So analysing firm performance using business model analysis techniques and metrics. When it comes to business model analysis, I have little doubt that many people would have been taught those traditional methods like SWOT and TOES and balanced scorecard and all of those wonderful things. You'll come to discover that in more recent times we've become a little bit more advanced when it comes to business model analysis, and we tend to try to account for platform models with a little bit more detail and a little bit more consideration. And so the most commonly used method to analyse a firm now, particularly an emergent firm, is the Asmaura method. It's sometimes referred to as a lean canvas. Has anyone heard the expression lean canvas? It's worth looking up. You might learn about it in management science, but it's what we're doing right now. Okay? The lean canvas methodology is undeniably the best way to engage with a business model quickly and come to terms with it. And this is the most important part, to be able to articulate it to a third party. Okay? Sometimes with traditional methods, you only end up with a summary of strengths and weaknesses. Okay? It's very hard to articulate a business model to a third party. With the Ashmayura method, with the lean canvas method, you have a set of tools, a toolkit that you can use to describe the activities of the firm. Okay? So if you've never used that before, those of you that are doing some management subjects, when it comes to that firm level analysis, try to use this method. What you'll come to appreciate that is, in finance, you need to be a very good all-rounder. Okay? Accounting is about stewardship and reporting. Okay? Management is about high-level procurement and high-level project and product and firm-level moderation. All right? When it comes to the human resources function, again, it's very much about the people and the people side and the process side. And when it comes to, for argument's sake, economics, that's very much the forecasting element of your organization. Increasingly now, it's not just economics, it's data science methods as well. But finance is about knowing all of those things reasonably well. All right? So you need to have very good accounting fundamentals. In fact, you need to know them better than accountants do, because you have to adjust for non-true cash flows. Okay? And you need to understand the managerial function and managerial process really, really well, because you need to be able to analyze, quantify, and categorize business models. Okay? You need to understand the HR side, because you need to understand key people and processes involved in organizational change to understand whether they're compelling leaders in the context that you want them to be compelling. And in truth, you need to very much understand the economics and data science process to engage in processes of forecasting such that you can discern whether the firm is going to be a viable one for you to invest in. All right? So being good at finance is about being good at all of those things. This is where we draw a little bit from accounting, but we make some adjustments. All right? In accounting, you learn about accounting ratios. When I worked at PricewaterhouseCoopers, one of the first super enjoyable things that I did was every time you'd go into a firm, you do an analytical review. The analytical review was quite simply a very high-level ratio analysis. Okay? It seemed silly to do at times because you had so much more data to work with. You had everything at your disposal, but it was your scoping exercise. It would allow you to put parameters and structure around your overall analysis. All right? I think this is the most beneficial thing that you will learn from accounting. I think traditional transactional matching is not going to exist in the future. Future accountants are going to have to be good at this. Okay, the managerial side of accounting. All right, so let's talk about some of these ratios. We're going to start by talking about capital structure, then liquidity, then debt servicing, then profitability, and then risk. In your exam, you're not going to be required to reconstruct ratios, but you might be required to interpret data. Okay, so you'll be presented with multiple firms and the data relating to those firms, and you'll be required to offer some comment or insight. I think it's a very fair way to assess the analysis element without requiring you guys to rote learn ratios. No one should be expected to do that. So in essence, in an exam context, you'll never be required to rote learn or memorize any of these calculations. They'll be, for all intents and purposes, presented to you in a tabular format in relation to a series of firms, and you might be required to interpret some of the numbers, okay, and offer some insight and comment, for example. And so in this course in the past, our emphasis has been on non-traditional business models, price-to-earnings multiples, and net tangible asset values. Okay? So those parameters that are critical to modern business and analysing modern businesses. Okay? But we'll talk more about that in a moment. So this is usually our starting point when it comes to looking at a firm, the debt-to-equity ratio. Okay, why is this our starting point? Well, it's a very obvious starting point. How much debt do we have in the business model? How much equity do we have in the business model? How do they relate to one another? The key thing to remember is we always need to be comparing apples with apples and oranges with oranges. Okay? If you were to look at this ratio for a bank, what would you discover? What would you discover?
Let's say the bank will give you 85%.
Yes.
The equity debt, you can look your equity. They'll be able to make a decision on how much to
Okay. Well, no, you're 100% correct. Well, and what we're trying to do now is kind of look at the firms, though. We're looking at them, and so we're looking at the bank's balance sheet. What would their balance sheet look like in terms of a debt-to-equity ratio? Well, if you were to look at them, you'd come to think that they're very risky. But they're not, are they? Banks are inherently not risky for all intents and purposes. They're very well managed. They have good leadership teams. They're in the business of managing risk. Yes, they will evidence a substantial amount of debt relative to equity. Does that mean that they're not viable business models? Does that mean that they're inherently risky? No, it means the complete opposite, in fact. It means you're not interpreting the ratio correctly. Compare the debt-to-equity ratio of a bank with a mining company. Mining companies have next to no debt. Okay? If you were to conduct a simple analysis, you'd probably very quickly draw the conclusion that, hey, one is very risky and one is not, and it would be a naive assumption. So you always need to be making appropriate comparisons. All right? When you're looking at retail companies, compare the debt-to-equity ratios of retail companies. When, for argument's sake, you're looking at banks, you need to compare the debt-to-equity ratio of one bank to another bank, or an industry standard. All right? So your benchmarking must always be logical. All right. The proprietorship ratio indicates the firm's long-term financial viability and stability. Essentially, it's the ratio of shareholder funds to total assets. Okay? And so what we're doing here is we're speaking to the amount that investors have contributed and the assets that have been generated as a consequence. So all things being equal, we can comment on the long-term viability and assurity of the firm by looking at the underlying asset base and how we've been able to generate value. So a higher ratio indicates less reliance on external funding. It means we've been able to generate value without having to up the ante in terms of equity issuance. Okay? Someone just say something? No? All right, sorry. If you were trying to, I couldn't quite hear you. All right, new liquidity ratios. So these are a good starting point, but we always make some adjustments, okay? So the current ratio is current assets to current liabilities, maturing within 1 year and due within 1 year. But the problem is that when you're analysing firms, you need to appreciate that inventory stocks are not necessarily liquid. All right, this is particularly important when you're analysing distressed companies or underperforming companies. There's a reason they're distressed, there's a reason they're underperforming. Okay? So please be mindful of that. Why are they underperforming? Why have they been distressed? This is the important adjustment that you always need to make, okay? Particularly when a firm is distressed. Current assets less inventory on hand, current liabilities minus your bank overdraft. Why? Because your bank overdraft is a dynamic source of funding and your inventory is not necessarily going to be easily sold. Okay. So, debt servicing is also of critical importance. There are a number of debt servicing ratios that we use. Debt to gross cash flow is a really good starting point. It just speaks to your ability to cover debt. But it's a little bit of a rough measure. We describe this one as a bit of a back-of-the-envelope type calculation, unadjusted measure. You can do this very quickly at a high level when you're looking at a balance sheet for the first time, just to get your head around the figures. All right? All right, so this is a better one. So earnings before finance, lease charges, interest and tax, and we generally in finance make one further adjustment. Okay, in finance we make one further adjustment. Okay, so we don't use the standard accounting ratio here. We don't use the standard interest cover ratio. What's the adjustment that we would make? Okay, we always need to adjust for depreciation and amortization as well. Okay, must always adjust for depreciation and amortization. You have to start getting into the habit of that. You have to sort of take off your accounting cap and say, all right, well, this is the accounting interest cover. Okay, it's not useful to me. I need to adjust for depreciation and amortization. I've seen articles published in major broadsheet publications claiming that Google and Microsoft made losses in particular years simply because of asset write-downs. Okay, they claim they actually made trading losses. Microsoft that year made $21 billion and Google made 14.3. And these people wrote articles saying both companies didn't make money. Needless to say that those broadsheet publications took those articles down and made some amendments to them, but my point is it's a very easy mistake to make. And modern write-downs can be very substantial. In recent years, every major corporation in the top 20 in North America has engaged in a major write-down process in a given year. If you believe that to be an underperforming year, you're not looking at the numbers correctly. All right? You must adjust for depreciation and amortization. Okay. Same is true of your profitability ratio. So EBIT to total funds is the accounting ratio. Okay, EBIT to total funds. Sometimes referred to as earnings to total funds. Okay? This is a particularly useful measure because it explains how much you've generated given the money that you've employed. Okay, shareholder funds and borrowing. So this is all of the resource pool together. How much have we generated based on the entirety of our resource pool? But we need to make one more adjustment. What's the adjustment? It's an accounting measure. We need to make it a finance measure. What do? We adjust for depreciation and amortization. Okay, so it's not EBIT, it's EBITDA. So it's still sometimes referred to as the earnings to total funds employed, but we use EBITDA instead of EBIT. Earnings before interest, tax, depreciation, and amortization. Okay? This is a really good measure that is underutilized. Why do I like this measure? Because this actually speaks to what the firm is doing. All right? So there are so many measures that you can calculate that speak to how much money you're making. All right? But Google, Microsoft, and Apple, they all make heaps of money through non-operating earnings. Okay? Several publishing companies make comparable amounts of money, or have in the past made comparable amounts of money, to Apple and Google in operating earnings terms. But they also generate substantial revenues through their investment holdings. All right? This speaks to the strategic decision-making of the firm. Long-term funds and earnings. Okay, what have you invested in long-term, and what are you earning? What I would say is that in addition to using EBIT, it's also sometimes really valuable to just focus on operating performance, not other sources of income. Okay? This is particularly true of Microsoft and Apple, because they both hold substantial amounts of cash holdings and a substantial amount of third-party investments. This is also to an extent true of Samsung. Okay, this is the most commonly used measure of all. This is the one that everyone would know. Okay, the most popularly used ratio in any sort of accounting type analysis. And that's the return on equity, net income to equity. Again, we can make adjustments to focus our attention. We can focus on operating earnings in particular, and we should adjust for any allocation of cost that is not a true cash flow. Okay? This is still a good measure even if it's unadjusted though. This is said to be the all-encompassing measure. If you're to present someone with one ratio, this is the one ratio you present. Okay? All right. So the next set of ratios, in my view, are the most important to modern enterprises. All right? I think they speak volumes because they're amongst a handful of compelling ratios that bring together a market-moderated value and a firm-moderated value. Okay, so they bring together the two sides, what we think and what the firm is doing. So the price-to-earnings ratio is your starting point in terms of developing a valuation model. And Calvin spoke to this last week. Price-to-earnings multiples are used frequently to value firms. Anyone watch Shark Tank this week? You'll note they all use the same valuation model. It's so frustrating. It's like 1 to 5 or 1 to 7. There are plenty of better ways to value a firm than that. Gosh. Imagine if you've...
So we have like annuity and perpetuity in this one.
Sorry?
Annuity and perpetuity.
Annuity and... So the annuity model, an annuity is just the valuation of a series of common cash flows. So with a firm, I would say that they're unlikely to always be common. They'll probably change. But you could use an annuity-based approach. You could. The only problem with using a perpetuity valuation is that you assume the cash flows are the same every year. And you can do that, but it's a little bit restrictive. Do you know when you would do that? If you were valuing real estate. So it's a good, simple way to value real estate very quickly. You can use a perpetuity model. Yeah? Yeah, most certainly. If you're capitalizing a value where it's a defined value, it's a good method. But firms tend to be a little bit more dynamic. So we tend to need to do a little bit more. But P/E multiples are a really good starting point. Okay, and it's not just 1 to 5 or 1 to 7. All right, gosh. Imagine if we valued all firms that way, particularly the innovative ones. We also like to value the IP that underlies a firm. Okay, if they've generated IP, there's value in that. All right, most people that engage in those processes of valuation, they're doing it as high net worth lay investors. Okay, so they have a substantial amount of wealth, but they're not actually analysing the underlying performance of the firm or the likely performance of the firm. They're using a simple multiple to take all the complexity away. All right? But that is not to say that it's a very good starting point. It is a good starting point. How else can we use it? Well, the high PE multiple indicates that we believe that this enterprise is compelling for the future. Okay, that it's going to do something compelling in the future. So we've looked in recent weeks at Google's PE. We've looked in recent weeks at Microsoft's PE, and we've looked in recent weeks at Facebook's PE. Facebook was trading at an outrageously high PE multiple at one stage, wasn't it? Almost 40 earlier this year. And it's traded at higher PE multiples in the past as well. So, again, this is a sentiment measure. It's a useful one because you need to remember it can change at any time. If the sentiment around a security changes, the PE multiple will change. Okay? So in the past, we've asked candidates questions looking at changes in PE multiples. What might underlie a change in a PE multiple? For example, just because a PE multiple rises, it doesn't mean it's a good thing. Let's say, for argument's sake, you're looking at two retail companies, and they both have common PE multiples. Okay? And they've consistently had a common PE multiple. But in 1 year, for argument's sake, the PE multiple of one of the firms increases dramatically. What could be the drivers of that adjustment in PE? Well, it can only be one of two things. It's a great thing about a ratio. Either the price has gone up a lot, or earnings have gone down a lot. All right? So we always, when looking at PEs, need to be mindful of the underlying data. We must always look at the PE while looking at the earnings data. Okay? This next ratio is really important when it comes to analysing modern businesses, all right? Price to net tangible assets. All right. Using this ratio allows you to approach certain investments with a degree of conservatism, but you also need to be mindful that modern businesses tend to not have substantial tangible assets, all right? So Facebook, what are Facebook's tangible assets? Sorry? Yeah, they've got like 3 buildings. They've got some furniture, they've got some computers. They're not really that much. The vast majority of their value was intellectual property. And prior to, I guess, the strong R&D program they've enacted and the purchases they've made, they've purchased a huge number of third-party firms because of their R&D. Facebook was predominantly just goodwill. It's a lot of goodwill, all right, to justify their valuation. All right? So it's really important when doing these calculations, there's nothing wrong with firms that are made up substantially of intangible and incorporeal assets. I know I keep emphasizing this, all right, but it's because no one else does. And this is what makes modern business go round. Intellectual property. All right? Intellectual property is the currency of modern business. Okay? So when you start your analysis, price to assets, very, very valuable. All right? And include goodwill. It's okay. Include measures of other intangibles like patents and goodwill if you can estimate them appropriately. But remember, during periods of uncertainty, what value do you go back to? What ratio do you use during periods of uncertainty? Price to NTA or price to NTA plus intellectual property, okay, where you can actually ascribe to appropriate intellectual property values. Because during periods of uncertainty, nothing else is valuable, all right? Goodwill is gone. Okay, case in point, anyone heard of Zynga or King? Anyone played Candy Crush? So you have then? All right, so King is the company that makes that game. What about Words with Friends? Sorry? Yeah. Words with Friends is Zynga, that's exactly right. And Candy Crush is? Yeah. All right, so are these valuable companies in your view, in your estimation? Think about some of these ratios. Think about their earnings potential. Think about their market prices. Think about, for argument's sake, their tangible asset backing. Are they valuable firms in your estimation? Well, they both listed in excess of $2 billion. Pretty good, considering one makes a popular game that is effectively a rip-off of Scrabble, and the other makes a game involving little candies being crushed, right? The point that I'm making is that they listed with very illustrious presentations, with very inflated valuations, and with me telling every single investor group that I was talking with and student group that I was talking with that this is the concern of modern valuation. We actually forget what underlies value, all right? Their values have halved, okay, since listing. Neither of them is performing spectacularly well. And the reality was there was a lot of hype and a lot of bravado around their releases, but they were never backed by any sound underlying fundamentals, all right? When it comes down to it, at the end of the day, if they were sold in a liquidation sale model, or for argument's sake, under extreme pressure, what kind of valuation do you think they would get? This is where you need to look at private equity transactions to inform your thinking. Okay? What kind of valuations do you think they would get? Very heavily discounted, based on earnings levels, probably maybe one-fifth to one-tenth of their presented value. All right? So you're talking about them realizing maybe at best $100 million, even though their market cap was around $3 billion. It's a big gap, all right? People might bag GM and Ford, all right? Those assets get sold. There's something to be sold. Okay, there's machinery, plant, equipment, intellectual property. There is something of substance, something of immense value, all right? So please keep that in mind. You will be required to do a little bit of interpretation in this course.
Just on that point about discounted cash flow, if investors are so interested in discounted cash flow, why are they not talked about? So we're talking about things that reflect future cash flow.
I get, most certainly, and I guess sentiment really drives so much of modern investment. And without a doubt, we're seeing some inflated values at the moment. I mean, I think Calvin presented some charts too, and I think Weepon presented some charts to you guys around some of the valuations that have been achieved by certain firms at certain points in history. And we're not seeing dot-com boom level overvaluations and overestimation, but we're seeing some real reaching happening at the moment. There is a lot of capital around, and people still seem to want to take chances. The venture firms are giving people good initial funding rounds, which means that when they're exiting, they expect an increment as well. And I have no doubt that's obviously driving valuations up to an extent as well, the fact that these firms have been well capitalized early on. But it is troubling, without a doubt. There are firms that are not, I mean, Amazon and Apple are not valued based on fundamentals. They're valued based on sentiment. There's a certain cohort that, really finds these firms attractive. What I would say is that the institutional investor groups are very conservative when it comes to these firms. Have a look at the changes in institutional holdings. They haven't really changed much. Okay? You have a look at the top shareholders in both of those firms and their institutional holdings. It's that next tier of investors, high net worth individuals that have money to play with, that are not basing everything entirely on fundamentals. They're basing it on beliefs about the future. You begin to discover very, very quickly that finance is also very much about predicting what people's beliefs will be. All right. Just going to check how many more slides I have. Only a handful. All right, so I'll get through these and we'll have a short break. Just a couple more. So when it comes to risk, we've talked about systematic and unsystematic risk already. Just want to refine your understanding of it a little bit more. That beta construct, again, is the discussion point that we return to. Beta is a very good starting point when it comes to understanding a firm's performance, because beta simplifies and subsumes all of the complexity of a security into one single relationship, its relationship with market. Okay? And so, for all intents and purposes, the average security should have a beta of what? If we're measuring the return of one against the other, if we measure the return of the market against the return of the market, what is the beta value? 1. All right? So the market beta is obviously 1. The average security will have a beta of 1. So any variation from a value of 1 suggests that the firm exhibits more systematic volatility or less systematic volatility than the average. And so we can use that as our starting point in terms of asset selection. A security with a beta of greater than 1 historically has exhibited greater systematic volatility. What does that actually mean when a textbook says that? It simply means that when the market has been up, the security has been more up. And when the market has been down, the security has been more down. Okay? So you might argue that it's, for all intents and purposes, probably been quite a pro-cyclical security. Okay? Market cycles tend, broadly speaking, to echo, how do I put it, the index performance. All right? So the security has probably been quite a pro-cyclical security. Okay? We don't know that until we actually match the data, though. If a security has exhibited a beta of less than 1, what does that signify? Yeah, less volatile in terms of market movement. And so we might actually describe a security that has a beta of close to 0 as being quite defensive or non-responsive. And those securities are compelling securities as well. Try to think about when those securities would be most compelling. When would you want defensive and resilient securities?
Like standard returns.
Yeah, you're correct, yeah, when you're wanting, I guess, consistency, but in times of uncertainty. Quick portfolio restructures just around betas, all right? I'm going to put my money into very resilient stocks, okay? Very resilient securities, okay? So think about it in those terms. It's a magnitude measure. Let's think of the equity betas of certain firms. What's kind of remarkable about the equity beta value, okay, please keep this in mind, is that the equity betas of firms do vary markedly, and there are some that are very pro-cyclical. Even though the examples presented in most textbooks and will be presented to you will involve betas of around 1 or just over 1, 1.5 and 1.7, many securities exhibit substantially higher betas and many substantially lower. All right? So many retail stocks that sell basic consumer durables tend to have very low equity betas, lower equity betas. So companies akin to Coles and Woolies in North America that focus specifically on staples, we don't have as many companies like that here, but those companies in particular tend to exhibit very low betas, are very resilient during periods of economic uncertainty. Why? Because during periods of economic uncertainty, people still buy milk, they still buy bread, they still buy cheese, they still buy all of those very fundamental resources that they need. The same is true of retailers that sell very basic retail goods. Clothing chains like Gap and so forth tend to have equity betas that are on the lower side relative to many of their more high-end rivals. What's remarkable, though, is that there's another extreme. The ultra-luxury category, remarkably, okay, and this is quite quirky, is counter-cyclical. During periods of economic uncertainty, people buy ultra-luxury goods, often to make themselves feel better. So caviar and ultra-high-end clothing sells well even during periods of economic uncertainty. But the really good examples of pro-cyclical companies are not the extremes. Okay, they're the companies that you're familiar with. So who do you think has the highest equity beta, for argument's sake? If you were to compare... Actually, let's not play that game. I'm just going to give you the equity betas. So Coors Beer has an equity beta of around 2.67, around the same as Apple. Okay? BlackBerry used to have a very, very high equity beta as well. Companies like Dell have slightly lower equity betas. Okay? Why do you think that might be the case? And what does that suggest to you in terms of investment sentiment and how you can allow this to influence your portfolio structuring at any given point in time? First of all, why is the equity beta of Coors and Apple so much higher than many of its rivals in the same category? I shouldn't say that, that's not entirely true. Most beer producers have very high equity betas. Most beer companies do. Why is that?
Because the activities are more volatile, like they depend upon the market conditions, like they keep on changing.
Yeah, so when it comes to securities that have historically been pro-cyclical and securities that have high equity betas, when markets are going well, people drink a lot of beer. They do. People drink more. Okay? people also buy goods that have a higher price premium, so cost of goods relative to price. They buy brand name things, like Burberry.
Even like antiques, something
Antiques not so much. Antiques seem to be quite consistent. Antique assets, depends on the asset class of antique, but yeah, so people during periods of economic uncertainty may still buy luxury goods, but during periods of economic certainty, they buy that category one tier below, something that's considered luxury and a brand name. So Nike, very high equity beta. Adidas, very high equity beta. Apple, very high equity beta. Things that are fashionable, okay? Things that they consider to be like fashion-like have a very high equity beta. But then there are some staples that always do quite well. So Dell is an enterprise company. They produce enterprise-grade technology. All right? They produce enterprise workstations, very expensive ones. They always sell them. Lenovo is the same. Okay? They have a more conservative equity beta because they sell well regardless of whether the market is up or the market being down. They're more of a luxury good, but they can still do quite well even during periods of economic uncertainty. All right, so that's how I want you guys to think about equity betas. When you're presented with them, think about companies that are pro-cyclical, think about companies that are not pro-cyclical, think about investment behavior, and think about how beta values can be used to construct a portfolio during periods of relative certainty and economic uncertainty. All right, so we're just going to do a couple of price examples quickly. Okay, this is the formula that you use to value a security. Okay, so as you can see, we have the dividend values as the numerator, and we have the 1 plus r to the t as our denominator value. All this denotes is that each dividend is discounted back to the present day to determine the value of a share. All right? So we use the share's sequence of dividends to value the share. When you have a share that has a constant dividend, a perpetuity, that's how you go about valuing it. This is particularly useful when you're valuing a preference share. Preference shares generally have consistent dividends, so you use the dividend divided by the required rate to value a preference share. And then we have an adjustment that we make when we assume an ongoing rate of change. So D0 is multiplied by 1 plus G, and then divided by R minus G. D0 is the most recently received dividend. These are the simplest valuation models that you can use, and they're still used very commonly in finance. What are we doing when employing these models? We're saying that the initial dividend is used to determine subsequent dividends in the sequence. All right? So if, for argument's sake, you've just received a dividend, that in the context of our notation would be D0. Okay? We adjust it by a common rate of change, and we divide it by our required rate to determine our value. But you might quite rightly ask, well, what would I do if my dividends are going to change over the course of the next 10 years? Well, ideally, you discount each of those dividends individually back to the present day, and then you have to make an assumption about an ongoing rate of change at a point in the future where you use this model. And so we'll do some examples like that after your break. All right? This is much better understood with the benefit of some examples. Okay? A dividend can become dividend, my apologies, a share can become dividend or ex-dividend. If it's come dividend, it means you have a dividend entitlement attaching. If it's ex-dividend, it means it no longer has that dividend entitlement. Okay, so a very simple example. Share price is $1. If a dividend is paid, the share price should decline to reflect that fact. Share prices don't decline neatly to reflect dividends paid. One of the remarkable quirks of markets. You can recall seeing some share splits and bonus share issues in Australian markets that have involved companies issuing bonus shares and the share price not adjusting neatly to reflect that fact. Okay, because the markets are very behavioral. People need to be aware that this is actually happening for the price to adjust. And it's kind of absurd, but not all investors are. So the price does not adjust neatly. People often generate gains during the time of declaration. All right. Bonus share issues are essentially the assignment of new shares based on your existing holdings. So if you have 10 shares, you might receive 1 bonus share for every 10 you hold. What's quirky about the provision of bonus shares is that nothing is actually happening. It's one of those great ways as an organizational leader to create the perception that you're doing something valuable for everyone. Here are some bonus shares this year because we love you. But in truth, they're not actually giving you anything. They're just capitalizing reserves. All they're doing is accounting for a value differently on their balance sheet. Okay. Why can they generate value on occasion? Well, as I said, the markets are behavioral. People don't always adjust as they should to the change. And so frequently bonus shares are provided, but the share price doesn't decline on a per share basis as much as it should. Think about it. If you have 10 shares at $10 each, you have $100 worth of shares. If you've now been given a bonus share, you should have 11 shares that are worth in total $100. Right? So 9.09 a share, thereabouts? Yeah? The problem is, it doesn't happen that way. And so gains are generated. Frequently you get a benefit even though nothing has actually been given to you. All right, so here's an example of what should happen. You have your come bonus price, value of 4 shares, and theoretical value of 5 shares thereafter. Theoretical value of 4 shares should be $4. If the price stays above $4, you've made a gain through the bonus share issue. All right. Share splits are not that different to bonus share issues. The only point of difference is that our goal here is to make the share price appear more attainable. Google was very anti this for a very long time. But even Google has started splitting its shares. Why do share splits kind of make a bit of sense? Well, the reality is we have seen historical prices, enduring prices on exchanges that are quite popular. It seems like the good numbers are between somewhere around $7. You know, somewhere around 7 is seen as an attainable value. People see that as an attractive number. It could conceivably go up for whatever reason. This is driven very much by a behavioral quirk. It also makes the securities a little bit more accessible. So Google and Microsoft have split their shares on a number of occasions. Apple has a couple of times as well, just to make the shares a little bit more attractive. All right. The provision of a pro rata right in relation to a share is a little bit different. A pro rata right is essentially the provision of shares based on your existing holding, okay, and you can acquire the share. The key point of difference here is something is happening. They're giving you the right to buy a share, all right? You're not getting a free share, they're giving you the right to buy one, which means that you're giving them capital. That's increasing the capital within the firm, all right? Sorry? This is a pro rata rights issue. In addition to that, we have dividend reinvestment as well. So a pro rata rights issue is like in the event you have 10 shares and each is worth $5. They now give you the right to buy an 11th share at $4.45 at a slight discount. Okay? This is actually a capital raising mechanism. The others that I mentioned weren't capital raising mechanisms. They were essentially just accounting transactions. Okay? So here we have a security with a price of $1. The value of 5 is $5. The new cash from the new share is 88 cents. Okay, one additional share, you purchased at 88 cents. That must mean that in total, these shares are worth $5.88, so the theoretical X price is 98 cents. All right? So something for you guys to be mindful of. This is an actual fundraising mechanism. All right, this is the equation that we use to value a right. It's a very simple one. Number of shares required for a right, N. The come rights price minus subscription price divided by N plus 1. So let's say for argument's sake you need 10 shares to get one more. N is 10. You then have your come rights price minus your subscription price and you divide by 11. Okay, very simple calculation. All right. I think that you guys can read about tradable indices in your own time. Very simple stuff. I think you've well and truly earned a 10-minute break. So if I could see you guys back here in 10 minutes, that would be great. We're going to do some calculations. All right? And also go through some research stuff that I think it could be compelling to you all.
Before everybody comes, I just ran in topic about the IPOs in 2017. So when I look at the year-end return, should it be like, because there are companies which on 30th of December maybe.
You can choose some cutoff rules. You could choose some cutoff rules. So you could say, for example, I'm only going to look at those that went to IPO in the first 6 months, so I have sufficient data. That's like a rule.
Yeah.
Or
I can select a sample based on.
exactly. So you have to kind of. I wanted to make the window not too big, so there wasn't too much work for you. But equally, by making the window smaller, you have to apply a rule.
Oh, I'll be selecting the initial returns as well. I'll analyze the initial returns of those.
Yeah, so you could do like 1 month, 3 month, for example, or 1 week, 1 month, 3 month, and that way, if you just pick that initial interval, you can maybe not worry about the second half of the year in terms of new securities, because those ones you won't have much data for.
And the other thing is, it won't be that like meaningful for me to have the information for 1 year's time with another company.
Oh, exactly. Most certainly, exactly. So you need there to be like a like-for-like comparison.
I'll just take maybe the first 6 months.
Yeah, it'll be kind of an imperfect thing, but you need the comparison to be equitable each time. The intervals must be common. Do you know what I mean? Yeah.
Thank you.
Well, no problem. All good.
I have some doubts regarding the assignment. This is the first research I have chosen the topic financial services on Google and
Okay, cool.
so not find much data on that.
Okay, so I can show you where you can get some. So if you tried those keywords into Google Scholar,
Yes, I have
you've
done
tried
that
them,
one.
and you didn't get
I
anything
got just only one report which is already previously done by someone else.
in Google Scholar. You only got one result.
Just I got one.
Really?
Yeah.
Okay. Well, how about we do it during the next segment?
Like after this.
Yes.
Yeah.
Yeah.
definitely.
Okay.
Yeah,
Cool.
Sure. Thank you.
Well, my background is of marketing, so
Cool.
I'm new to this. So I don't know how to do the assignment because I'm finding in
It's
Google
a very marketing assignment.
yeah, I'm
when you think
finding
about
in
it.
Google Scholar, so they are showing me the different topics, but I'm not able to understand that.
Okay.
What they are
So
talking
what,
about.
so what topic did you like out of the list?
Equity crowdfunding and the future of life.
Okay. So what do you think those things mean? So equity crowdfunding is obviously how we raise money. So there are new laws that have been put in place that allow you to raise money through crowdfunding. So that's one question, right? So these laws are quite new, which means that now people can raise money from the general public without going to IPO, right? In the past, and in India right now, the only way you can raise money from the public is how?
IP.
Exactly, go to IPO. But now, in Australia, in the US, in the Nordic countries, in a number of countries in Europe, you don't have to go to IPO. You can raise between $5 and $20 million each year without going to IPO. Isn't that interesting?
Yeah.
So how do you think, in your estimation, that might impact upon future fundraising? What do you think might happen? What are your thoughts on that?
If general public stop investing in IPOs, they'll invest directly in the crowdfunding.
Well, it may be that, look, an IPO is still great because it still means that people can divest. How do I put it? An IPO still creates an opportunity for some existing investors to realize their gain. So firms will still come to IPO, but maybe not as many, and maybe later. And the other critical consideration is that in addition to equity crowdfunding, you also have ICOs. ICOs are another crowdfunding mechanism. They are. I mean, they mightn't be called that. In fact, well, they are called that. It's an initial coin offering. But in the technical documents, it uses the word token because within Australian law, within most jurisdictions, you can't use the word coin. All right? So they're effectively raising money, and literally hundreds of millions of dollars, through coin offerings. Why would you go to IPO if you could do 2 coin offerings at $100 million each? If that's satisfying your short-term needs. So these new mechanisms are presenting the potential for people to delay their pursuit of crowdfunding. Is that still on right now? It is still on, I think. Let me see. Just making sure I'm still on. So does that kind of making sense? So think about it from a marketing standpoint, all right? You're marketing a company, right? And you're marketing a new IPO, all right? So you have the choice as a company leader, okay? The company is saying, all right, we'll need to raise money and you're going to help with the marketing campaign, all right? We can go to IPO using the formal financial market. How do you feel about marketing that versus going and raising smaller amounts over a longer period through an easier mechanism. And as a marketing professional, you would say, well, I can market this more easily than I can market going to IPO. There's going to be a much broader marketing campaign. We're going to need a lot of resources, complex product disclosure. You're going to have to give me time. With this mechanism, no complex disclosure rules. You're allowed to put together a marketing campaign for a qualified investor, so you can put something together quickly. It doesn't have to be long form, and you can raise the money for your company. So it's actually, in some respects, it's kind of a marketing thing too. You know, marketing one offering versus marketing another. Clearly, people are going to gravitate to the thing that's easier to market. If you were to look at it from your marketing background, does that make sense?
Yeah.
Yeah. So how's that helping?
So I'm not able to understand that how should I do the assignment.
So what you need to do is put together a structure that explains how things are, recent changes. Okay, so traditionally you talk about how people have raised money through IPO,
So I need to.
and then you need to talk about the changes. And so the changes are
Australia, or I can compare.
you
it
can
with
you can
US or-
choose whatever you want to do. It's left to you. So you start with the initial discussion how things are, then you talk about how things have changed. Last year we have equity crowdfunding laws, right? Here and in other countries, and now people are also raising money through ICOs. How are these two changes going to impact? Exactly. Simple as that. So introduction, what's happening at the moment? How's it been before these changes?
current
And then, maybe some literature. So you can have literature review, just get some papers, maybe 4 or 5 papers, summarize what they've said on IPO performance and what they've said about equity crowdfunding, what they've said about ICOs. Right? And then you go into, you might have one little statement that says, I'm taking a case-based approach. That's your methodology section. So in this assignment, I'm going to be doing some simple time series analysis and some case study analysis to provide a commentary on how I feel the market will change as a result of equity crowdfunding and ICOs. And then it's just your discussion. Yeah. How does that feel?
Yeah.
Bit better?
Yeah.
All right, and you can email too if you have any
sure,
issues.
sure.
But it's your first assignment. No one expects you to write, a piece for, MIT Business Review. Not this time. Maybe next semester. If you have a subject with me next semester, 760, right? Then it has to be for a top-tier business publication. No, I'm being serious. Being facetious and serious. It's really about you developing as an author. You're building this skill set, because in the other subjects they won't really be talking to you like this about it.
Yeah.
They'll just expect you to do it. Do you know what I mean?
Yeah.
So the idea is that this is a bit of a warm introduction, a little bit of a nicer way to get started. And so you can email me things, you can talk, you can give me a call, but the idea is that we want to hear what you think, informed by other people's opinion. Okay?
Yeah, sure.
Great. You email, all right, if you have any issues.
Yeah, thank you.
I don't kind of today. Is it okay if we do it? Is it okay if we do it after? Is that sorry? Is that okay? Yeah. Is that okay if we chat afterward? Is that okay? Okay. Sorry about that. Yeah. Hey, is it okay if we have a quick chat afterward? I'm running a little bit further behind than I expected today. Is that okay?
Yeah.
Okay. Thank you. All right, guys. Let's make a start. We have to get this done in 20 minutes. So, I do appreciate your patience and understanding. First of all, did you guys get my notes on this? I put them on the home page. If you haven't downloaded my notes on this, I put together some step-by-step instructions, how to do the calculations. 2 different versions, one using the formula and one using first principles. Okay? So please make use of them. All right, so just a few things to sort of start with. I might just start with the calculations so we get those out of the way. I feel like you have a good capture of the theory. Our dialogue would suggest that, and we've invested sufficient time. So when it comes to valuations in this course, at this level, it's not going to get too much more complicated than this. So we're going to present some of the foundational examples and then some examples that involve some variation in initial dividends. Okay? So there'll be two potential scenarios that you could conceivably encounter in your final assessment. One will involve a simple valuation where you make an assumption at the outset. Okay? The other scenario might involve discounting a series of cash flows back to the present day and then subsequently making an assumption about an ongoing rate of change in the dividend. Okay? In the real world, you'll be doing the latter more than you'll be doing the former, all right? So we're just going to do these ones again. We looked at one of these quickly last week. I'd like to just do it again. As I said, very indicative of the style of the question that you might see. A couple of questions like this for 5 marks, for argument's sake. All right? So Big Pies Limited is the producer of consumer products. The company paid a dividend of 20 cents 1 month ago. 20 cents 1 month ago. Okay? The company is expected to maintain a rate of change in dividends of 10%. Given the risk associated with the firm, a discount rate of 15% is deemed appropriate. What is the value of this company? So we'll just open up Excel very quickly so we can do the calculation. Okay. Okay. So D0 equals 20 cents. What is D1? We need D1. Okay? Our formula is going to be D0 multiplied by 1 plus G divided by KE minus G. This is the simplest valuation method. The starting point, it is known as the dividend discount model or dividend discount method. So we have D0, we need to find D1. Okay? But you might ask, well, D1 isn't in that equation. D1 is in the standard equation, it's just not recorded as D1 generally. D0 multiplied by 1 plus G equals D1. Okay? So another way to record the formula might be D1 divided by KE minus G. How simple is that? That is the simplest valuation method that you can employ. Very good scoping exercise, very good starting point when doing a share valuation. So let's do the calculation now. How do we go about doing that? Well, we have D0. D0 is 20 cents. So how do we find D1? It's going to be D0 multiplied by 1 plus G. So on this occasion, it's going to be 0.20 multiplied by 1.10, 10%, exactly. And what does that equal? 22 cents. All right? So the next step is simply going to be discounting D1, the next dividend that we're to receive in the sequence. We've already received D0, by our required rate of return minus our rate of change. So our required rate of return is 15%. Yes. Rate of change is 10. So 0.15 minus 0.10. Okay? We'll just do the calculation. You need to remember when you do this in Excel, you always need to use brackets. All right. So we'll do the calculation now. Hopefully you've had the chance to record it. If not, Still fairly straightforward for you to do in your own time. So the security is worth how much? $4.40. We would value this equity at $4.40. All right, so next question. Blue Shoes Limited is a producer of consumer durables. They paid a dividend of 50 cents, or they will pay a dividend of 50 cents in 7 months' time. So the phrasing is different here, a little bit more confusing. So 0.50 equals D0. Okay? My apologies. No, it doesn't. It equals D1. That's what I was trying to write. And I wrote completely the wrong thing. All right, my apologies. So the point of difference is that this is D1. Why? Because we're yet to receive it. Okay? A dividend in our pocket is always D0 or less than D0. Any dividend that we're about to receive is D1 or beyond. On this occasion, it's the next dividend, so it must be D1. Yeah, it should. My apologies. Just so the company will pay in 7 months' time. My apologies. It should actually say declared. The company has declared a dividend. So often a company will declare a dividend, and then 6 to 8 months later, the dividend will be paid. So in this case, even though the dividend is declared, it only counts as a dividend in your pocket when you actually receive it. So we use it as D1. So that makes the calculation very straightforward on this occasion. Okay, it's going to be 0.50 divided by 0.20 minus 0.10. Okay. So we'll do the calculation. Oh, my apologies. It is. Oh, this is me trying to be tricky. All right. Yeah, okay. Okay, so what's our answer? Yeah, very good. All right, so what can our answer be? It's your first rule of valuation. You can never have a rate of change that exceeds your required rate. Valuation can never have a rate of change that exceeds your required rate. So you cannot conduct a logical valuation under these conditions. All right? So if, for argument's sake, you're presented with information like this, what is the error likely to be? If, for argument's sake, you're asked to present a valuation on comment on whether a valuation is possible, what are you supposed to say? Sorry, this is me being tricky unnecessarily, I know. It is necessary because people make these mistakes all the time. So it's often the case when you're presented with valuation information that you estimate a rate of change based on your ROE and retention ratio, and you end up with a very, very high value. Okay? And then you need to determine a corresponding discount rate. That's where you have far more control. Your discount rate must always be greater than your rate of change, regardless of the method that you use. Okay? Even if your method is logical, and quite frequently logical methods result in these outcomes, but it simply means that you've not accounted appropriately for risk. Okay? All right, let's extend upon the first question now. I'll show you the answer. My apologies. We got a logical answer. Do you know why? Because we don't have any brackets. Excel actually gave us an answer. Okay, so could you have a -5 valuation? No, you can't, obviously. So, yeah. You can't have a negative valuation. Like, an asset can't, because of limited liability, an asset can't be worth a negative amount to you. An asset can carry liabilities in excess of its assets, but it can't be of negative worth as a subunit of value to an investor. Okay, so let's extend upon the first question, just briefly. If, for argument's sake, in the first instance, with question 6, rather than making an assumption about our dividend in year one. If, however, we were to lay claim to a series of dividends being paid over the next few years rather than just making a single assumption about one dividend, how would that approach change our method of valuation? Let's say, for argument's sake, in question 6, rather than stating the dividend is paid at 20 cents 1 month ago and that it's going to change at a rate of 10%, what if, for argument's sake, the question stated dividend 1 is to be 22 cents, dividend 2 is to be 24 cents, and dividend 3 is to be 26 cents each year on year? How would that cause us to change our valuation? So that would mean that D0 equals the value as presented, 0.20, D1 we denote as 0.22, D2 equals 0.24, and D3 equals 0. We'll make it an extreme example just to make it fun. So I'm going to change that to, I'll make that a little bit higher. Otherwise it'll be too consistent with the common valuation. You can estimate it in your head otherwise. We don't want that. If you were presented with these values, how would you go about conducting your valuation? Yeah, so the only point of difference is that we need to account for each of these cash flows individually and then use D4 to find the value of all dividends thereafter. Okay? So we would have to also make an assumption about D4. Let's say, for argument's sake, D4 equals D3 multiplied by the rate of change. That's all we need to complete our valuation. Okay, we have the quoted dividends and we make an assumption about the dividends thereafter. All right, so how do we go about completing the valuation? So we simply divide each of these back to the present day. Actually, I'm going to have to do it, because I've made it clear to you guys, I'm going to have to do it individually again. Okay, and so our rate of change is 1.5. My apologies. Sorry, I've made it clear for you guys, but it makes it harder for me. Okay, required return. That's fine. Sorry, I forgot my power. Add my power. Power of 2. And the last one is equals, I'll explain it to you just after we do the calculation. We'll get the calculation up here, and we'll go through it step by step. Okay, so what I've done with the first 3 dividends is that I've discounted them back to the present day by dividing them by 1 plus the required rate. Okay, so D1 is discounted back to the present day by divided by 1 plus the required rate. Okay, standard discounted cash flow methodology. So that's how we make the adjustment to the dividend discount model. We just use standard discounted cash flow methodology. All right? And so now this goes from an ongoing model to a variable model. Okay, this is called a variable model, a variable dividend discount model. All right, so we have our first 3 dividends, but now it gets a little bit more awkward. We need to estimate D4. So I'll just estimate D4 over here. So it's 0.30 multiplied by 1.10. I know you guys know the answer, but I'm just going to put it here anyway, so you have it in front of you. It's going to be 33 cents. So D4 equals 33 cents. So how do we value all dividends after that point? Well, all I do is discount D4 by KE minus G. This is my ongoing rate assumption. Okay, my ongoing rate assumption, my ongoing rate of change assumption. Okay, so divided by 0.15 minus 0.10. Yep. Okay. Okay, but what's the problem with that value? Yeah, exactly, but why? Yeah, so that value is the value of all dividends after year 4, but I've only discounted it by KE minus G. That takes it back 1 year. So what terms is it in? Exactly. That's exactly right. Because if I use D1, it brings me back to D0, right? If I use D4, it brings me back to D3. Very good. All right, so our final step is simply to bring this back to the present day by dividing it by, it feels a bit weird because we've done 2 discounting steps. One only took us back 1 year. This takes us back the remaining 3. 1.15 to the power of 3. My apologies. Forgot my multiplication. I think I'm working in pure math where you don't have to write one. All right, there we go. So this is the value of all dividends after year 4, inclusive of year 4. So what do I do next? I'm just going to move this, just so it's not in the way, in terms of aggregating our values. Actually, no, I'll leave that there. It's good for you to understand the steps. Equals shift plus and there we have our valuation. All right? So if, for argument's sake, you're presented with a series of dividends, you account for those dividends individually, you bring them back to the present day, and then you account for all dividends after that point. All right? This is the real world. No one makes an assumption at the beginning. Okay, you get paid as an analyst to make rate projections, rate of change projections, and also to determine an appropriate discount factor. And then to estimate as many dividends consistently as you can based on contract understanding, relational understanding, market share understanding. All right? That's where you bring value. In this course, generally, however, we do take a step back and we generally present examples like this, but you might also see an example that has a little bit of variation at the beginning. So 2 potential scenarios. One, where you make a rate of change assumption at the beginning, and one where you make a rate of change assumption after a handful of cash flows have been defined. Okay? 2 scenarios. All right, just very quickly before we kick on, we're only going to get a handful of minutes to do this. I really wanted to introduce you guys to sort of a couple of platforms that I feel will be compelling for you in terms of your research. All right? Do that one. That's fine. Okay, so I've talked to a few of you guys about SSRN. I think it's probably one of the best social science resource platforms that's out there on the market. You can check it out. It's entirely free. It's owned by one of the major publishers. You can find a lot of resources this way. So, for example, those of you that are studying crowdfunding, to enter that keyword into a search, and you can see I have 650 papers on crowdfunding. And you can sort them based on date and relevance. But what you will find about this platform is the most compelling aspect is that the papers are generally of a very high quality. So people put their working papers here often before they publish them in full. Okay? So all of these papers, for the most part, the most compelling papers are published in top-tier journals. So you'll see both publication outputs. When you go in, it'll actually state that there are multiple versions. Okay? So this is a good one. Initial quote offerings and the value of crypto tokens. Okay, it's from the MIT Sloan Research Program. It's likely to be a good one. Crowdfunding and federal securities law, for argument's sake. All right, so this is, again, a very simple way to get a huge amount of research material very, very quickly. Okay, so I typed in one word, and I was able to get quite a bit. All right, let's type in a couple of other compelling words very quickly. And again, those of you that are studying Brexit, please remember, we're focused on the Brexit referendum event. Okay, that's your key declaration date. for those of you that are doing something empirical. Okay, so here you've got slightly fewer results. You've got 618 papers. Okay, but still more than enough to get yourself going. It does take a little bit of time to sift through some things. What I'd encourage you to do is start with the abstract. Okay, focus initially on non-technical papers. Non-empirical, non-technical papers. Start with some general papers that ground the theory, or general papers that focus on the law, or general discussion papers. Okay? Once you have that literature material, then you can incorporate some discussion from the more technical or empirical papers. All right? But there's a huge amount of material out there. I know a few of you guys have said, I've spoken to a few of you guys doing Brexit, and you've said that it is a challenging one to talk about. There is a lot of material out there on this. When it comes to data, for those of you that want to do something empirical, okay, check out World Development Indicators. What am I doing? All right, here we go. So it's entirely free. Okay, this is the downloadable version. You can go to the data catalog as well. If you want to download it in full, you can download it as a single download, 36 meg. Or you can go to the data catalog and you can create a specific query. Okay. So let's say for argument's sake I wanted to go to the data and resources. Okay. As simple as that. And now I just select the variables that I want. There are over 1,580. Okay? A number of them relate to finance. So venture funding, industry-based investment, FDI, sector-based FDI, a lot of the things that you'll find interesting. For those of you, for example, that are doing the Brexit study, you can get the pre and post data this way. Okay? Those of you that are, for example, focusing on a question relating to Australian markets, you might want to get some Australian data relating to Australian property performance pre and post the enactment of, for argument's sake, negative gearing. I'll concede that there are other factors that are going to impact the outcome, but I don't expect you to build a regression model. These are some methods that you can use, some tools that you can use to get some general data around the question that you're talking to. Okay? All right. For those of you that want additional data beyond this, you can go to the US Federal Reserve website. They keep a lot of unique data there on the subjects that you're covering off on as well. And Taylor and Francis, they're a UK-based journal publishing group. They also capture a lot of Brexit-related data in particular. Those of you that are doing any topic relating to Australia, obviously you can use the data download and data API from the Australian Bureau of Statistics website. Those of you that are doing a banking or finance topic, you can quite simply go to the Department of Treasury website. And one of the best, in my view, in terms of data availability is the Reserve Bank website in Australia. The ASIC website and the Reserve Bank in Australia make available a huge amount of data as well. Okay? But you'll find that this is probably going to be sufficient for the majority of you, for those of you that want a quantitative element. All right? You can. I do find that they're a little bit more light on. Of course you can, as long as they're reputable. But they do tend to be a little bit lighter on and a little bit less substantiated. But of course, yeah, if they're good periodicals. Fortune and Economic Times are probably good examples. Yeah, they're quite reasonable. I would encourage you to look a little bit beyond that though. If you can, even if you can just get into the habit of it now. I mean, I don't expect everyone to be quoting, 20 or 30 top-tier publications, but certainly a handful suggests you've done some research.
What do you think about the credibility of Wikipedia?
Wikipedia is a lovely resource to learn from. I would suggest that if you are using Wikipedia, you go to the actual source material for Wikipedia. So all the material in Wikipedia is cited. So if you click on the link, it'll show you the original source material. Go to the original source material. Wikipedia directly is sometimes less than ideal. That's exactly right, yeah. All right, well, look, that's the extent of what I wanted to have a chat about. I was keen to talk to a few of you guys about how to access some of the material. books and so forth online, I might have to do that on the forum. Okay? So I'm going to stick around for another couple of hours. I'll be at the corporate centre, but for the next 15 or so minutes, I'll be out here for those of you that would like to have a chat. Okay, thank you for your patience. It was a longish session, but as I said, it's an interesting one. I think that the equity session is an interesting one. Do feel free to ask any questions that you have. I'll certainly be available to have a chat. All right? I'll see you guys next week. I'll be here on Wednesday. Yeah, I know, I'm planning on leaving. I can talk now, though. Feel free. Oh, okay. Yeah, today's quite a cool day. So I kind of 7 afternoons online from kind of like 4 onwards. So I tend to not take meetings between 3 and 4. Normally, I think I'm going to be around till still free though. Yeah. Wednesday if you want though. Yeah. Evening Wednesday?
Maybe I will come in on Wednesday.
Okay, so yeah, let's make a time for Wednesday. Yep. Today I have to leave at 3. Yeah. Cool. All right, no problem. Yeah, so remember on the assignment sheet there was a little link. Did you click on that link?
The parameters which you guys.
No, there was a little link there that said